what Fed is indicating is that they are willing to put up with a lot of pain.
The market's going to give the Fed not much credit, frankly.
Whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done.
If we tip into a recession, you could have a fair amount of earnings weakness.
The recession is not a question of if, it's a question of when.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Waking up to a little bit of optimism this morning from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Julian Emmanuel of Evercore alongside us. We'll catch up with him in just a moment. Equity futures right now on the S&P 500, negative almost 0.1%. TK, call after call. Goldman Sachs dropping its Eurozone recession call in the last 24 hours. Morgan Stanley getting super bullish on Chinese assets. Just a little bit of optimism, a constructive view, TK, this morning.
What are they going to do on Friday after the inflation report? Everybody's going to recalibrate off that report. No and for buts. I mean, it's all there is to it. I get the euro recalibration right now, but what I would look at is the elephant in the room is the Bloomberg Financial Conditions Index before we go to commercial break may go positive. There is absolutely no way I would have guessed that 3 weeks ago.
Does Chairman Powell push back against that in 3 hours' time?
Not should. He has to. Even the people that are looking for a more accommodative Fed need a chairman that can say, no, we're just not going to be that accommodative.
If you're long risk right now, are you fighting the Federal Reserve? Chairman Powell speaking at about 3 hours' time. Lisa, HSBC, Max Kettner, bearish through the whole of 2022. Then this morning, we change our view.
Yeah, and it's interesting that it's happening in the second week of 2023 to show you how quickly things are moving and how much sentiment is shifting. Basically saying that originally it was that it's going to dip and then rip, right? We had been talking about that. It's going to be a bad first half.
You said dip and rip.
That was you. I'm going to say that. That was you. That was 100% a John Ferro branded saying. But then he said it's going to be reversed, that it's going to be a better than expected first half, and then it's going to be a worse than expected second half, and that now he's actually neutral on stocks, overweight on credit, and neutral on cash. In fact, in some ways, underweight. So this is just a complete recapitulation of his original view.
I'm looking at Julian Emmanuel, and he's just itching to jump in on this. Julian, dip and rip. I think Mike Wilson and Morgan Stanley asked yesterday.
We don't do this for Ed Hyman.
We wouldn't do this for anyone else.
We're going to come off the show. Only Ed Hyman would get this treatment.
Mike Wilson turned around and said, how is the consensus wrong? He thinks it's not the direction, it's the magnitude. Max Kettner coming out this morning saying first half might be better than people expect. What do you say?
Well, look, you know that we're in the dip and rip camp. Okay?
I know.
And frankly, being in the consensus has always been a point of bother for us. But when you look at it, you know, you're fighting this whole notion that the Fed is going to hike at least 50, maybe 75 basis points more. And the ISMs, both manufacturing and now services, are in recession territory.
Sub 50 and people still want to buy this market. We'll talk about it in a moment. Equity futures right now down 1/10% on the S&P. Julian is going to stick with us. That's not the length of the interview. We'll catch up with Julian in the next
Thank you, Julian.
couple of minutes. Just let him go. We'll speak to him again as well about Europe. China reopening and getting bullish on Europe. We're going to talk about that too. Futures negative then. Yields up about a basis point on a 10-year. Your yield this morning, Lisa, your 10-year, 354.67.
A lot of people leaning into the long bond kind of trade. Can the Fed push back enough? I just want to say yesterday, Atlanta Fed President Raphael Bostic said, I'm not a pivot guy. So perhaps Fed Chair Jay Powell says something similar. 9 a.m., Jay Powell does take part in a panel discussion on central bank independence. He is speaking at the Riksbank in Stockholm. He will be followed by a host of others, including ECB Governor and Council member Pablo Hernandez, DeCos and Klaus Knott. They're also speaking, but later in the day around 10:30 a.m. Eastern. How do they talk about the move in the markets? Tom, you mentioned the easing of the financial conditions. They will have to push back against this. What can they say that's actually going to get the market's attention? Right now, we're looking at two-year yields in the U.S. that have come off, that have actually plateaued. But in Germany, people are buying into the story that it is going to be a hawkish ECB, partly because of that optimism, partly because you have seen a reversal of some of the bearish calls with Goldman Sachs saying that Europe is no longer going to enter a recession. Does the ECB kill that excitement by saying, OK, now we raise rates and we raise rates a lot? So that has been the tone, and that has been recognized both both in FX markets as well as bond markets. And at 1 p.m., the U.S. will test the waters. And this is actually interesting. And Tom, I know you're going to laugh, but the U.S. is selling $40 billion of three-year notes. It comes at a time of so many questions around what's going to happen with short-term yields. The Fed, one member after another, coming out saying we're going to hike above 5% and we're going to keep it there for a very long time. The market not buying it again and again and again, basically plateauing significantly lower from some of its recent.
Is there something? Is there something, John, called auction gloom?
Auction gloom.
Auction gloom.
I spoke to Lisa for about 2 minutes this morning, and she sounded almost constructive, endorsing some of the views we got from Max Kettner and HSBC. Lisa will be back in the studio. She'll weigh in on that in just a moment. Julian, let's start here with Chairman Powell. 3 hours away. Tom mentioned it. Financial conditions have eased somewhat. Do you think he pushes back against that?
He does.
Do you think it works?
Here's the issue. The issue is there's a lot of positioning going on in front of Thursday's CPI. So from the aspect of a cap being on risk assets, like we saw basically 2 hours into yesterday's session, it probably does work. But it could be an entirely new narrative after that report comes out.
Your shop invented the synthesis of equity analysis and economic analysis. A guy from Texas did this a few years ago. Synthesize right now the enduring Ed Hyman belief that America clears itself like nobody else. We will get through higher rates. We will get through all the tech layoffs and all the other drama that's out there. Synthesize the optimism on your floor right now.
Well, point blank, Ed has been of the view a good 9 months now that inflation is going to fall faster than the market believes. And thus far, it's starting to materialize. His full year inflation forecast is 2.5%. The golden two handle, okay? That is an entire new set of circumstances for the Fed to deal with if, in fact, that's right. And you know, that is probably in and of itself the argument for risk assets that we think materializes at the end of the year.
At the end of the year, but not at the beginning of the year. And this is what I wanted to raise, because I actually understand what Max Kettner is getting at, and people who are saying, wait a second, the data isn't that bad. There has been a change in facts with better than expected weather, warmer than expected weather, and a China that's reopening. Why isn't that enough to sustain things for a bit longer before people hear what Raphael Bostic is saying? I am not a pivot guy.
Look, no question about it. The surprise to me when I got to the green room was to look at natural gas and realize it has a 3 handle on it after what we've seen the last several months. That's a big deal. But at the end of the day, we have this set of circumstances where the Fed is intent on reining in the labor situation. And the only way you do that at this point is to cause, I wouldn't call it a material slowdown, but look, Ed is looking for a couple of negative GDP quarters, what we used to call until the first half of last year, a recession.
Okay, and I understand the dig there, as a lot of people are saying. It didn't actually happen. So what causes the rip? What causes the upside if the Fed is determined to bring inflation down, if they're really going gangbusters there, and you don't necessarily get some sort of fiscal impulse or anything to really drive things in the other direction?
It's essentially this idea that there is a terminal, endpoint to the hiking. You don't necessarily need to see the easing, and the market is probably, and I think we're going to hear this in a few hours, incorrect in believing that there's going to be any sort of material easing in 2023. But what it really is what you have every time at market bottoms. There has never been a bear market bottom without a capitulation, without an emotional volatility spike, and that in itself clears the playing field for the next bull market, and we think that's going to happen.
If I'm not 100% in cash, where am I? What sectors have value and have protection?
We continue to think that value has value, okay? It is going to be challenged for the next couple of weeks at
dividend
a minimum.
Growth? That value?
That's part of it. Look, we're very defensive-minded right now. Consumer staples, healthcare, and energy continues to be, it's sort of the piñata back and forth, with waves of emotion and, ticks in the oil price. But at the end of the day, even if we dip into a recession, energy is 5% of the index weight and is going to account for 9% of the earnings this year.
So you don't think tech can regain leadership here? It's basically the message.
In the short term, it absolutely can, but in the long term, look, the fact is that the investing public still owns too much FANG.
You're a student of market history. I think what we're all leaning on here is this idea that it's incredibly rare to get a market low before the recession. Isn't that basically the argument here?
Yeah, in a nutshell, absolutely. It would look. Again, we have to take it from the jump-off point that everything that we've seen in the last 3 years is about, has very little, if any, historical precedent. But this is one of these things. The entirety of 2022, we were asked, when's the capitulation? When's the catharsis? When's the emotion? It's coming.
And this ain't it yet. Seems to be the message. Gillian, we get lucky. Going to stick around. Going to talk about Europe as well. Just the optimism, all of a sudden, not just the China reopening, but we mentioned a number of months ago, the number one thing you needed in your outlook was a meteorologist to come by and give you the weather forecast for the Europeans. And that seems to be the change.
It is a surprise. And frankly, it's in the United States as well. Not so much that we're as warm as them, but we're not freezing, et cetera, et cetera. But I do agree, John, that has been the magic, pleasant surprise.
My phone was lighting up this morning. Tadeo just ping, 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 message. Have you seen this? Have you seen this? Goldman dropping its call. Deutsche Bank saying perhaps we could escape recession, Bramo. Just message after message, research note after research note saying the same thing.
But this is where a price can determine the sentiment, because right now some of the other indicators are also moving the other way. Small business optimism just came out below estimates, just to give you a sense. So there is that as well.
Well, I go back to what Julian said. We've got ISMs at -50.
Yeah.
Or rather below 50 in contraction territory. The ISM, Julian, when was the last time the Fed hiked with the ISM sub 50? Do you know that?
It is
the last time it happened?
There's only been a couple of precedents for it. We actually ran that yesterday. As I said, just a couple of times, and the outcome has not been terribly pleasant over the near and medium term.
It's a very unique moment for this Fed, Tom. Incredibly unique.
Well, yeah, and these comments this morning. When's he speaking? 9 a.m. is it?
9 a.m. Yeah.
Yeah, 9 a.m. So this is a morning event, folks, as we get into Thursday. And I think the summary here is important. It is a toxic brew of dip and rip. I mean,
a toxic brew of dip and rip.
It's a toxic brew of dip and rip.
I will say, we're going to spend a lot of this morning teeing up this conversation at the Riksbank with Chairman Powell. Spoke to Mike McKee yesterday. It's unclear how much he's actually going to address current monetary policy. So perhaps bear that in mind, that we might tee this up and then get absolutely nothing. We hope we get something. There's a Q&A session in the mix as well.
We better get something.
They better ask good questions. In the next hour, Amy with Silverman of RBC. Gillian Emanuel sticking with us. Maria Tadeo out of Europe up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. A Singh cooperation deal would leave Bankman-Fried even more isolated. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. The measure is not expected to pass once it's sent to the Democratic-controlled Senate. Attorneys for President Biden discovered classified documents while packing up the Washington office he used after serving as vice president. The White House says the materials were turned over to the National Archives. The Justice Department is reviewing the matter. Former President Trump is under investigation for his handling of classified materials at his Florida estate. In the UK, ambulance drivers will go ahead with another strike planned for Wednesday. A senior union representative called the government's latest effort to avert more strikes in the health service an insult. Prime Minister Rishi Sunak is facing pressure from his own Conservative Party to fix the crisis. And Bloomberg's learned that Microsoft is in talks to invest up to $10 billion in the creator of artificial intelligence bot ChatGPT. Now, proposal calls for Microsoft to invest the money in OpenAI over a period of years. The two companies have been discussing the deal for months. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
The Fed is actually not data dependent here. They're path dependent. They've essentially chosen a policy rate at or just above 5%. And the goal is to get there and then hold that level in place for an indefinite period of time, most likely, the balance of this year, unless the economy crashes or financial markets crack.
Mike Data was fantastic yesterday, the chief economist and macro strategist at MKM Partners from New York. Good morning to you all. Equity futures just a little bit softer. We're down 0.25% on the S&P 500. In about 2 hours and 40 minutes, you'll hear from Chairman Powell. We'll bring you his address at the Riksbank in full, of course, and get you all the headlines from Mike McKee as well. Equities down, yields are higher by a couple of basis points, 3.55, and euro dollar back with a 107 handle on the euro, 107.35, and Goldman dropping its recession call, saying the following: we no longer look for Eurozone recession, reflecting better growth momentum, sharply lower natural gas prices, and earlier China reopening. We upgrade our Eurozone forecast notably above consensus. Maria Tadeo joins us now out of Europe in Brussels. Maria, where is this Eurozone optimism coming from?
Well, Jonathan, there is bullishness today in this morning. There is something in this environment. You talked about that note from Goldman Sachs. They dropped their recession call. They now see positive growth of 0.6% this year. They talk about this mild temperature. The reality is we were told this was going to be the winter from hell. I had a very nice 3-week break in Spain, and the temperatures were not freezing. We have seen actually better than expected weather. Gas prices have dropped massively. That removes a lot of the risk premium. And then, of course, the China reopening, which they say will be good for made in Europe. Funnily enough, we also had a note from Deutsche Bank almost an hour later that essentially said when you look at the PMIs, it looks like this recession can be averted, and also noted this China reopening also positive for the euro.
Maria, you covered the ECB. No doubt that if we can escape that recession, this ECB is just going harder, isn't it?
Well, if you remember back to that December meeting, she repeated many times, Madame Lagarde, that she was not going to pivot, that she was going to continue to hike no matter what, that they were going to be restrictive, that there were no limits potentially to the actions that they could take, that this was the #1 priority, and repeated so many times there is going to be no pivot. So that's where she left it, and that's, of course, where I guess she would want to repeat and pick up in this new year. But, of course, this data, will it change something for them? When you look at Goldman Sachs, in their note, they say 50 basis points in the next 2 meetings, 25 basis points in May. That's what they predict.
Maria, thank you. Maria Tadeo there on the latest out of Europe. Euro strength, dollar weakness. The dollar, DXY, is down almost 10% from the highs, Tom, in late September. That's quite a move.
We had a momentary print of a 102 handle, which is a huge deal. It's a huge signal. This is the major trading index. Bloomberg Dollar Index is more sophisticated, more varied, has China in it as well. This is a raging debate among the FX people. Mark McCormick to join us here. Is this a weak dollar trend yet? Jane Foley pushed against
Is it the real deal? 103 on dollar index right now. Julian Emmanuel of Evercore alongside us in the studio today. Julian, what do you make of all this euro optimism we're waking up to this morning and this dollar weakness we're seeing as well off the back of this China reopening story?
In the immediate term, it may be a little bit in terms of the reaction of euro dollar at 107. That's understandable. But the bigger picture is that what the last 9 months have been about is ridding the Eurozone of the psychology of negative interest rates. It's very difficult to overstate how important that is for risk assets, for investors, assessing capital allocation decisions, in that part of the world. And frankly, when you think about the discount for over a decade, during which time the dollar rallied almost consistently, it makes sense, the case for Europe.
What's revenue growth do if we get an Ed Hyman inflation scenario, which is a 48 or 52, I can't remember, even into outright deflation in the early 50s? What does corporate revenue growth do given a rapid disinflation?
It's certainly going to decline, and it's going to decline faster than the market expects. Is it going to go negative? Very unlikely, because frankly, again, you have the other side of the fact that you've got so much stock of consumer savings, And in that environment, one might be able to argue that you're going to have, I wouldn't say a soft landing, but not a crash, to call it over 5% in the unemployment rate. And so you're still going to have that backstop that gets you through the shallow recession to the recovery in 24.
If this is true, does that mean that the Fed, the ECB, can remove accommodation completely, go from negative or zero to 2, 3, 4% without causing a financial crisis, without causing a crash, a normalization that just leaves a couple potholes, but not that much more along the way?
It's very difficult. It's literally only happened in 94, 95. And interestingly enough, when you look at 94, that was the only other year in the bond stock quadrant where you had negative returns to both bonds and stocks. Granted, they were nowhere near the scope of what we saw in 2022, but the upside is it is possible.
But we reverted back to low yields after that, and it really entered this decade, these 2 decades, 3 decades of the incredible bond rally. If we don't get that, if this is the new normal, maybe not this high, but a 3% Fed funds rate, an ECB rate of 2%, does that mean that we can just live with that? That it just is basically money isn't free, but it's not going to necessarily cause some complete re-rating of stock and bond returns for a longer period of time?
It is possible. It's going to compress multiples. It's going to compress leverage. It's going to compress valuations across assets, but it isn't a deal killer. And at the end of the day, it doesn't depress materially the concept of earnings and earnings growth, which is what drives stock prices.
In Europe, this goes beyond the weather. This seems to all go back to China. I think so many of the calls that we're seeing this morning are underpinned by this more optimistic, constructive view on China reopening. Morgan Stanley were pretty blunt about it. We believe the market is underappreciating the far-reaching ramifications of reopening and the possibility that a robust cyclical recovery can occur despite lingering structural headwinds. So I'll make it really simple. I think for a lot of people waking up this morning in the market, they want to work out whether they should be investing in a story where growth slows or investing in a story where growth rebounds. Which one is it?
We think there's a very good case to be made for China assets right now. In fact, our China strategist, Neo Wang, thinks we get to 6.2% GDP growth.
This year?
Yep.
Wow.
Yep.
That is stunning.
Yep, exactly. And
the ISI Evercore Asian economist feels they get a 6+ handle?
Yep.
Wow.
Absolutely.
John, what we're talking about here, in my head is spinning over where we were 3 weeks ago. I believe 3 weeks ago the world was ending as we know it. And now we've got all this optimism here, and only one thing has changed. Disinflation in Spain, disinflation in France, some other place I can't remember. This stunning 6% call on China, and what are we going to see Thursday in the United States?
So I'll answer my own question. I guess it depends where you look. If you look to China, things look better. If you look to the United States, maybe things look worse. And Julian, just as a final question, that tees up the question we ask almost every single January, every single year, is whether we can get outperformance ex-US, whether that's where the outperformance is. International markets beyond US shores. Is that where it is?
So it's been a fits and starts type of argument. And again, if you look at the broad sweep, it's because of the prevalence of negative rates in much of the rest of the world and because the dollar has rallied. We think that we're not saying you're in a dollar bear market, but the dollar has topped in our view, and that is absolutely tailwind for rest of the world outperformance.
Julian, this was great. Julian Emmanuel of Evercore in the studio. Thompson, massive calls on the Chinese economy and the FX market too.
Yeah, and also Ed's idea of disinflation in America, but without question, the hallmark call this week away from what we're going to see Thursday is Evercore ISI with a 6% plus China GDP. That's
monster.
I'm sure I've missed somebody, but to me, that's like you say, it's a monster.
That's above Goldman as well.
I'm not focused
above
today. I'm sorry.
Morgan Stanley, I believe too.
I'm off.
Are you distracted? Why?
I'm distracted because somebody said the tots may go on sale to the.
To a Qatari investor.
You know,
right?
what's that?
Wouldn't
Nobody
you like
called
the money?
me.
Wouldn't you like the money?
I don't know.
Would you like to front a consortium?
Can Harry block this?
Harry might be going to United. Just in there. Some chat about that too. The main event this morning, Chairman Powell, 2 hours and 30 minutes away. Going into that, equity futures down about 0.2%. Good morning to you. On the S&P, we're negative. On the Nasdaq too, down a little more than 0.1%. Into the bond market, big move lower in the 2-year to start the year. Over the previous 2 days, down 25 basis points on a 2-year. We tried to bounce this morning, up 2 basis points to 4.23. Elsewhere in the FX market, the call from Goldman, you know it well now, dropping their recession call on the Eurozone. Euro dollar through 107 and maybe having a look at 108, 107.40 on Euro dollar, up by about 0.1%. This, of course, can all change with the words of Chairman Powell later, and inflation coming up on Thursday. Investors questioning whether we have seen the peak. Atlanta Fed President Raphael Bostic weighing in, saying, quote, if the CPI comes in showing the same kind of trending that we saw in the jobs number, that will make me have to take 25 more seriously and to move in that direction. But we still have some time to go before that. So that's Bostic, Tom, on the size of the move at the next meeting, 25 or 50. He was asked, once we get to 5%, how long we'll stay there. Tom, do you know what he said? 3 words, a long time. So it's really about how long they stay at terminal. That's the tool they're using to really push back against these rate cut calls we're seeing elsewhere.
These well-meaning people, including a frontline economist like Mr. Bostic, they're very visible. They're in the Q&A, the press conference, wherever they are. And, John, it's real simple. Do we want the presidents of the Fed gaming 25 or 50 beeps like a derivatives trader at SocGen?
Hasn't this become the game?
I just won't participate. I don't
actually
agree.
think
you
it
hold on a
matters.
second. Hold on a second.
Well, no, it matters. And I think it does matter because what they're trying to do is set up a 25 basis point rate hike that isn't viewed as a dovish signal, that they're backing away. And they're trying not to ease financial conditions more, but build in some insurance. It's a real issue that they're trying to make that is very difficult, but that is what they're trying to signal. And that's probably
I think what they're trying to
debating.
signal is they have to get to Thursday's inflation data and retail sales. I believe it's next week, the 18th.
Hold on a second.
I believe.
You hold on.
I'm holding on a second.
I agree with you, though. It's true what you said.
See, they're piling on.
It's quite straightforward. It's just Brammer's so fired up this morning. So fired up. Chairman Powell, Tom, 2 hours and 28 minutes away.
I'm going to have a Tang Zero break.
Is that strong?
Agree with each other.
Is that one strong?
I don't like the aftertaste. It's like Coke Zero. It's just not the same as it could be. Let's get some intelligence on this. Lindsay Piegza with us, chief economist at Stifel. Lindsay, I'm going to cut to the chase. Our audiences, our viewers, our listeners, their heads are spinning. Atlanta GDP now is a stunning 3.5% plus guesstimate of where we are. The fourth quarter looks pretty good after all the gloom. Where is the assuredness of economic slowdown in this 90 days, or dare I say even Q2?
Well, I think the assuredness comes from the weakness that we're seeing on part of the consumer. As a consumer-based economy, if the consumer is not out in the marketplace, happy and healthy, we would expect a meaningful decline from that more robust pace as we saw in the second half of the year. And against the backdrop of negative real income growth, higher borrowing costs, and of course, many consumers facing the risk of variable rate debt resetting in the first quarter at higher levels.
Well, that's right.
This will compound the pressure on consumers.
Lindsay, you're reading my mind. The chart yesterday, I believe Zero Hedge had it. Thank you, Zero Hedge. And it was, I think, a Bloomberg chart. I can't remember. Of the credit card interest rate is a variable rate. I mean, we're all looking at housing and that. But fold into your analysis credit card rates that were 21, 22% that are now 28, 30%. How does that play in to the caution?
Well, it plays in significantly, particularly as savings are now drawn down to near zero levels. Remember, the consumer was very much supported by this accumulation of wealth during the pandemic and the immediate aftermath. We estimate there was an additional about $6 trillion in terms of a wealth cushion supporting consumers. And that removed any sense of immediacy to revert back to the normal labor force participation formation that we'd seen in previous cycles. But now as we go forward and consumers draw down that savings, we're seeing this return to a reliance on credit card debt. Now, arguably, the household balance sheet is beginning from relatively a healthier position than in previous cycles, but still, we don't have this unlimited amount of wiggle room for consumers to take on that new amount of debt. And particularly as that debt is now repricing at higher levels, this will compound that pressure, as I said, on consumers. limiting their ability to go out into the marketplace. That doesn't mean that consumers are going to fall off a cliff, but that does mean a meaningful loss of momentum. And again, as the key part of the economy, it's going to be nearly impossible to maintain then that level of 3% growth as we turn the corner now into the new year.
So, Lindsay, would you push back against some of the optimism that we've been hearing from people who have been pessimistic through all of the second half of last year?
Well, I think the timeline for the pessimism to set in was extended. Consumers did prove to be surprisingly resilient through much of this turmoil in 2022. But again, it doesn't negate the fact that these outlying variables will weigh on the consumer and limit their ability to spend. There's only so much savings that we can draw down. There's only so much credit card debt that consumers can ramp up. And so just looking at this from a quantitative perspective, regardless of our qualitative optimism, the numbers suggest that consumers simply will not be there in the first half of the year.
Does changing the timeline change the depth of whatever downturn you're expecting to happen? In other words, does it make it less or does it make it more as new excesses build up now?
Well, I think the depth and duration in terms of the downturn is very much going to be hinged on monetary policy and the sticky nature of inflation. The higher that prices remain, the longer that prices remain in this uncomfortable level relative to what the Fed can withstand, that's going to force the Fed to raise rates higher and potentially keep rates higher for a longer period of time. And that's going to be the scenario that's going to compound that downturn and the duration of that downturn.
You know, Lindsay, I know you hang on every word we do. And Julian Emanuel is just on with Mr. Edward S. Hyman and their team in Asia modeling 6% plus China GDP. Not that I don't need you to tell me that's what we're going to see, but if we get 5.8, 6.2, whatever, what does that do to exports and imports in your U.S. GDP math?
Well, certainly it's going to be difficult to get to 6%. That's extremely optimistic. That being said, it does seem as if there's nowhere to go but up when you're talking about an economy emerging from a nationwide shutdown or more restrictive zero COVID policies. But that being said, what we've seen thus far has been far from an ideal reopening. It isn't a flip the switch scenario. So it's more going to be a slow bleed, particularly against the backdrop of a number of black swans that continue to float around, those with over-heightened optimism, new variants, a lack of natural immunity to the virus. Any of these resurgences, as deemed by the government as inappropriate or intolerable, could lead back to many of these zero COVID policies. So I do think it's overly optimistic to think that once the door cracks open, it's going to swing wide open and get us back to that structural fluidity that we saw prior to the COVID pandemic.
John Pigsley there was on the edge of Bramo. I mean, that's what I noted there. I mean, you know, she's on the edge of Bramo this morning.
I think a lot of people waking up this morning feeling like they're being told conflicting things. We've got this
huge.
survey data
In the last
sub 50
3 weeks
for manufacturing and services. Then we've got this big boom that people are talking about over in China, and they're wondering whether they should be pricing in slower growth or a growth rebound.
Yeah, Lindsay, what's so important here, to go back to your earlier insight, is variable rate. John Farrell lives this in England. They're the land of the variable rate, the floating rate mortgage, and all that. How big a deal is the variable rate in America? I'll get it out.
I think it's a very big deal, particularly when we go back to the conversation we had about consumers. When we're talking about credit cards as a key support to consumer spending going forward, as that interest charge continues to rise, that's going to limit the ability for consumers to access alternative sources of income, aside from returning to a more traditional position in the labor market. Now, this could actually be somewhat of a double-edged sword, but a positive in the way that if consumers feel they can't rely on these alternative sources, that may create more of an incentive for these sideline workers to move back into the labor market and help increase that labor force participation, which, of course, as labor demand outpaces labor supply, we've seen this upward pressure on wages. If we see the reverse occur, that could put some welcomed downward pressure on wages, something the Fed is certainly looking for.
Just real quick here, if you choose a data point, you can tell your own story. You can pick whatever data point you want to edify your view. That has been basically the belief for the first couple of weeks of this year. Which data would you be watching most closely for a true read on the pace of how the economy is developing?
Well, I think when we turn the page looking at the consumer, I think negative real income growth for the better part of the past year tells a longer-term story about the unsustainability of positive spending activity. And that is really going to be the driver of 2023, whether or not the consumer can continue to shoulder these elevated prices against the backdrop of negative real income growth.
Hey, Lindsay, thanks for this. Lindsay Piexer there of Stifel on the US economy and the global economy for that matter, ahead of the Federal Reserve Chair, Jake Powell, speaking a little bit later this morning. Big change from the team over at HSBC. Max Kettner this morning. I think this got the attention of many of you. Having been staunch bears for more than a year, for much of 22, we think the consensus is wrong about a weak first half and a second half rebound. The team at HSBC went on to say we see a variety of reasons to be less bearish on risk assets in the first half, with depressed growth expectations being key. Tom, he was max underweight equities for so much of last year.
Oh, he's the gloomiest guy we visited in London.
Without a doubt.
No question.
We're going to catch up with Max at 7:15 Eastern Time.
We are. I didn't know that.
About 35
Nobody
minutes
tells
away.
me anything.
And that's a big change from him and the team.
Yeah, it's a big shift here. And, you know, you fold it into what Steve Majors talked about. And if you get an Ed Hyman disinflation, what does that do to Steve Majors' long-term caution on the certitude of higher rates?
If you get an Ed Hyman Evercore China GDP story, six handle.
That's something we will remember and monitor 6 to 9 months from now.
Totally, Lisa. A couple of months ago, I don't think anybody was thinking about 6 handles out of China GDP for the year ahead.
Nobody was thinking about them elevating the debt ceiling levels and how much they were going to offer to the stimulus as well. So there are a lot of different factors here, not just the reopening in China.
Can I segue?
Well, it depends on what too, but sure.
Okay, well, you and I both, and all three of us, I think, say enough on Bitcoin and SBF, whatever his name is. This is heating up, folks, in the last 24 hours. Now, we've got Coinbase just out moments ago with layoffs, and it's 950 people, John, but they only got under 4,000 people. So it's like a 20% cut or whatever. But the bombshell here is yesterday, Forbes magazine had an article, Javier Paz over there, of the money walking out of this Binance. I have always said I'm way more interested in the investigation and the allegations, speculation about Binance than any of this SBF stuff. That's what I'm watching in January.
And when we get some news, we'll bring it to you.
We front ran that on the crypto show. You can see that today at 1
I don't think we
p.m.
want to front run anything.
We're just out front on the crypto show today. We're selling it.
We're going to talk about foreign exchange next.
Should I have a beard like Miller? What do you think?
It depends. I like you with a grey beard after a vacation when you're a bit more chill. You know, you don't want a grumpy beard.
Is it the beard?
No, you want a chill beard. Yes. There's a chill beard, then there's a grumpy beard. Yes. You know, when you come back from vacation, Tom, it works.
Ho, ho, ho.
Mark McCormick coming up next from TD from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's attempt to send the first satellites into orbit from its own soil has failed. A rocket launch from a Virgin Orbit Boeing 747 that took off from England malfunctioned. That led to the loss of its payload of 9 satellites. The jumbo jet and its crew returned safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order for the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. China is striking back at countries for imposing COVID-related curbs on Chinese travelers. Beijing has suspended issuing some visas for South Korea and Japan. It's China's first attempt at retaliation after a number of nations implemented testing requirements for travelers from the country. Apple's push to make more components for its devices in-house is hitting more suppliers. Sources tell Bloomberg that the tech giant is dropping a key Broadcom Wi-Fi and Bluetooth chip in 2025. Apple also reportedly plans to make its own first cellular modem chip by the end of next year or the following year, swapping out electronics from Qualcomm. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Starting point is the SEP, putting it between 5.25 and 5.5 if memory serves. That's a reasonable place to start. But we're going to need to go in and imagine as the data roll in, do we need to go higher or could we stop a little earlier? I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that, but that's where I'm putting it right now.
That was Mary Daly. So much Fed speak in the last couple of days. The San Francisco Fed president speaking to the Wall Street Journal just yesterday. We'll hear from Chairman Powell a little bit later this morning. Equity futures right now on the S&P down about 1/3%. So much optimism out there around Europe, just relative to the pessimism that existed a couple of months ago this morning. The likes of Goldman dropping its recession call on the Eurozone. Right now, euro dollar 107.37. We're positive there by about 1/10%. The move in the dollar since the highs of late September. DXY down by almost 10%. That's some real dollar weakness, Tom, that's come through in the last couple of months, and much more so, again, in the last couple of days. We heard from Mark McCormick recently of TD. This is what he had to say about the dollar. In 2022, inflation, momentum and carry were all the rage. Now the focus has shifted to value and growth. Keep in mind that terms of trade still matters, but the momentum has reversed in favour, Tom, of the importers like the euro, yen and Korean won. Another shift from last year. The Korean won, TK, last couple of days. Major moves. I think levels we haven't seen going back to last summer, last June.
That's I believe that's on the Pacific Rim, and that's what I'm looking at as ADX DMY. This is a really important conversation. Let me frame it with you before we go to the wonderful Mark McCormick. On a technical basis, I am dead set on the death cross. I think it's absolute total Mickey Mouse mathematics. There are other things related to it that are really important. And there's a 3-moving average exponential study which has finally shown weak dollar trend just in the last couple days. There's other indices that people like Mark McCormick or Jordan Rochester use to confirm that. They haven't confirmed yet, and that's a setup to go to Mark here right now. He is with TD Securities. Mark, I'm going to cut to the chase. We're going wonk like you and I used to years ago. Wells Wilder in 1978 looked at momentum and came up with something called ADX DMY. It is yet to signal weak dollar trend, but on BBDXY, ADX DMY is awaiting a trend. Are we going to get that trend? Is it going to confirm a moving average study?
Yeah, I think we are. I think we're moving in and out of regimes. That's been really the way we've been set up for the whole pandemic, that we kind of get 3 to 6 months, maybe even a year of one thing, and then we move into the other. And as you mentioned, we're kind of moving totally out of the inflation regime. We're moving into something new. And I think that new regime is really going to be focused on how the global economy is reacting, how certain countries have divergence across financial conditions. But a big thing that's going to really drive this is, again, the reversal of the terms of trade and the repositioning of equity markets. And the optimism around equity and the optimism around growth. It's not really optimism per se, but really stabilization of the global economy and moving out of stagflation. So that will help confirm the trends in the price action because the macro regime is changing.
In the last decade, one of the people codifying regime change has been James Bullard. He has talked in the last number of weeks, maybe a month, maybe 6 weeks, about the trajectory to higher interest rates. He's stunned with a 7% number. Can your world stay pieced together in stability if we get Mary Daly's, say, 5.25%, dare I say 5.5% terminal rate?
I think 5.25 is manageable. I think part of it is really the journey, right? So a lot of the price discovery and the volatility that came across different asset classes, if we think call it macro volatility, the VIX, the move, currencies, all of that had to do with the discovery of where the terminal rate's at. And I think even if we go, our expectations that we go to 5.5, I don't think that needs to be a tremendous shock to markets, but it does shake up positioning. So our view is that in the very short term, we could see the dollar consolidate a little bit, maybe give back 1.5%. But the next move over the next quarter, the next 2 quarters is a 5% move lower against particular currencies. So we're in this environment where positioning and technicals are going to matter. But we are moving into a momentum-based regime change that is going to be ultimately bearish for the dollar.
Mark, where am I getting that 5% move? What against?
I think it's against a whole host of things. It's going to be, if we look at, we're still extremely bullish on the yen. I think there's a very good amount of upside for euro. If we can get down back to about 105, we can use that as a level to buy into for a move through 110 for the first half of the year. I think the other currencies, again, as we talked about Asia a little bit, Aussie, Korea, those guys look quite appealing in this backdrop. And I guess there would be a little bit of a rotation to SEMA as well. on the back of a stronger euro, which would also probably support Poland.
Mark, I saw the move yesterday in $1, the Korean won, dropping to its lowest level since June. That's some one strength. Everything in Asia was stronger against the US dollar. Can you tell me where the Aussie fits in? You mentioned it there. How important is that trade going to be?
Yeah, Aussie's quite important because what it is, it's one, a reflection of kind of Chinese growth, and two, it's a reflection of kind of the dynamics around what's happening with commodities. If you look at commodities over the last 3 months, the sector performance, which is what matters for FX, kind of the composition, is really the most important factor. And what we've seen is energy prices have underperformed and industrial metals have outperformed. So this is a focus on the Chinese reflation trade, which again, is somewhat in its infancy. But as you can kind of see, consensus is stumbling over itself to push up Chinese growth for this year. So Aussie fits into it. One, if Asian equity markets are outperforming, Aussie's just going to kind of be lumped into that backdrop. Two, if Chinese growth is performing in terms of trades improving in Australia, that's going to give the RBA a little bit more confidence as well. And it's also going to be supportive of capital flows and trade flows into Australia.
Mark, within these interdependencies, if we get Evercore ISI's stunning 6% plus GDP call for China, what does that import into America in terms of the inflation guesstimate out 6 months, out a year?
Yeah, that's an important question because as we just talked about, the commodity prices, particularly different parts of it, maybe not energy, but other things will move higher. So we do have a bit of a tug of war where China could introduce more inflation into the U.S. economy, but at the exact same time, all the supply side mechanics, if you look at the Fed's supply disruption index and also PMI delivery times, all those things are also linked to China closing and to China lockdowns. So I think what we have is the supply side, which has been, really kind of not focused on it over the last year because people have been focused on the demand side of how we can reduce inflation that way. I think the big thing is that China reopening basically helps the supply side continue to improve, even if it's somewhat stimulative for inflation from the demand perspective. So on net, we probably have still inflation moving lower, but maybe it kind of settles at a higher level with China reopening.
We'll link this into Priya Misra's work. I mean, she's just been phenomenal on inversion as well. Dominic Constam over at Mizuho says risk assets can win this year. That's an outlier call, I would suggest. Do you and Priya suggest risk assets can win?
Yeah, I think they could. It's largely a function of kind of linking the things we talked about around stagflation. And again, from an FX conception, you think about three things. You think about global economy, where we were in September when we talked about the peak of the dollar. China was never going to reopen, and the Eurozone was going to have a very long, drawn-out recession based on energy prices. We got the miracle weather that people were looking for that was a very good cushion to get Eurozone past this through their recession. And again, the data is coming in better than expected. Terminal rates are about to peak. And again, the terms of trade shock has reversed. So if you think about what risk assets need, risk assets were focused on stagflation. We no longer have stagflation. We might not have an acceleration in global growth because U.S. is now the laggard, but we do have stabilization at the exact same time. What we should also start to see is some acceleration coming from Europe and China to offset the slowdown in the U.S. So this is a great environment, not for U.S. risk assets, but it's a great environment for non-U.S. assets, particularly equities in Asia, which is why this is very bearish for the dollar.
I keep hearing the same thing, Tom. Keep hearing the same thing about ex-US, international. I feel like we've done this a million times. And as for Europe, I just wonder how soon before we start worrying about next winter. And not the one we're working through right now, but the optimism is there for all to see.
But you don't do it in a vacuum. If you assume international goes on weak dollar and robust GDP recovery, can domestic and G3 equity markets also rise with them, if not as much? I think that's left out of the discussion right now.
Mark McCormick at TD Securities. Mark, thank you. Lisa, you and I have talked about this a million times with regards to China, not the demand side, the supply side. Mark touched on it there. We're still trying to figure that out. Is this supply side relief or further supply side dislocations?
We don't know. And a lot of people are seeing this right now more as relief and fueling growth more than anything else, including even shrugging off the potential demand for crude and for natural gas.
We've got Max Kettner in about 20 minutes. What do you want to ask him? What's behind this change?
And also, how significantly does this affect the magnitude of the downturn that he's expecting in the second half?
The second half rip that we're expecting, is that now the second half dip, if you expect the rip
It's a
in the
rip
front
and dip.
half? Is it?
It's a toxic brew.
Rip dip.
I think we need to go to London and see Max and the entire HSBC team there to rip and dip.
Oh, do you? You'd like
rip
to make
and
that
dip.
happen? Is that a night
Rip
out?
and dip.
Is that a night
It's
out?
kind of candy.
Plural, he said.
You rip it, tip it.
It's either London or Indiana. We can go to either one.
I'll take London. So, I mean, no offence to Indiana, of course, but
keep it up.
I was just a home bias there. Just seriously, no offence.
What Fed is indicating is that they are willing to put up with a lot of pain.
The market's going to give the Fed not much credit, frankly.
Whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done.
If we tip into a recession, you could have a fair amount of earnings weakness.
The recession is not a question of if, it's a question of when.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get you set up for the trading day. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures not doing much this morning, down about 1/3 on the S&P. A few hours away, TK, from hearing from Chairman Powell.
We're going to hear from him, but are we going to hear from him? I have trouble here, John. With it. He's in Sweden, right? Is the
Riksbank.
Right? The Riksbank, which is a really important historical bank. But are they going to contain the questions because they're so polite over there to not obnoxious questions like you get from Michael McKee?
We should send Mike McKee every time Chairman Powell speaks.
Excuse me, sir. I'm from America. I'm clicking.
Can you imagine that, Lisa, if Mike McKee just starts stalking Chairman?
There's a Bramo smile, folks.
Just
That was a Bramo Tuesday
waiting
smile
in the corner,
you saw there.
just sort of, skulking around, waiting. You probably wouldn't take the question. If he did take the question, would he answer it? And what kind of question would it be at a time when the market's not listening?
He's got to maintain control. I mean, I don't know what this is. I'm going to call it Whipsaw Tuesday, where we were 3 weeks ago versus the conversation this morning for Global Wall Street. My head is spinning over the shift.
Lisa has touched on the heart of the matter. The chairman and his words carries more weight than the rest of the committee. But have those words lost weight over the last couple of months? Because, Lisa, what he's selling, I'm not sure this market is buying at the moment.
They've looked past it. If you've taken a look at two-year yields in the U.S. over the past couple of months, they've plateaued. They're not going higher, even as you see this resilience, even as you see this optimism that's causing yields in the euro region to increase. If that's the case, the market's saying we're seeing something that you're not, because your rhetoric has not changed. If you're saying 5% is still the low that you potentially could see on the
Should we talk about some of the optimism out there this morning?
Let's. Yes.
Goldman Sachs first. So Goldman come out and drop their Eurozone recession call. Morgan Stanley get all bulled up on Chinese assets and growth that maybe pushes close to 6%, at least in the high fives. And we heard from Evercore about an hour ago that they could get 6% plus GDP growth in China. And then Max Kettner, he's going to join us, Lisa, in about 15 minutes' time, suddenly turns more constructive on risk.
In fairness, a lot's happened. This is actually rooted in true events. And if you have a reopening of China that was surprising, and then also fiscal support coming from China, that is surprising. And then weather that is historically warm in Euro. And oh, by the way, there are natural gas tankers floating around that can't find homes. There's that much in terms of oversupply.
You see in the supply shock, I don't know the exact numbers, but at one point you had a 20,000 handle on moving a ship across the Pacific, and it's crashed down to $2,000, just as another indicator of the dynamic shifting.
We're trading the weather. Did you expect that?
No, I don't.
You've been saying that for months.
I'm not.
Basically bringing a meteorologist.
You're not trading the weather?
Nope.
No, why not, Tom?
I just think it's too unpredictable. It's like the Red Sox.
So my issue with the weather story and the crude and the energy story and the gas story in Europe is as follows. This was one winter. What about the next one?
Exactly.
And if you're going to get bulled up on the Eurozone economy, how long for? When do you start worrying about the next one?
People say that they're actually much better set up now for the next winter because they're at 91% stores. And so heading into the summer, it could potentially be a much better setup heading into a time when they cannot access the Russian stores. So some people are even speaking that way, that they're optimistic even on that level. So this is the level of optimism that we're getting.
The heart of the matter, Ed Hyman's call, as we spoke to Julian Emanuel, is do we have disinflation, like the two bouts of disinflation in the late 40s and the early 50s, really nothing else matters, and everybody's got an opinion on that.
CPI on Thursday.
Huge.
And to Lisa's point in the last hour, the markets and price can change sentiment pretty quickly. And I imagine based on Thursday's print, things could change again. Equity futures right now on the S&P down 0.33%. We're negative by about 11 or 12 points. In the bond market, yields are higher by about 3 basis points, 356.33. And Tom, euro dollar unchanged right now, but we have reclaimed a 107 handle.
Yeah, there, and I frame it out. Deutsche Bank looking at a 115-ish, and Kitchuk's, I thought, with a really smart note at SocGen saying, X Putin, X the war, right now settled, it should be a 120 stronger euro.
Bramo, that's the euro call after a couple of days of real dollar weakness.
Yeah, honestly, the euro call has been amazing, and the dollar weakness really has pervaded the sentiment that we've gotten pretty much across the board. Today, we've been talking about at the big event, Fed Chair Jay Powell taking part in that panel discussion on central bank independence hosted by the Riksbank in Stockholm. What will he say that actually will matter? At 10:35, we get the ECB Governing Council members Pablo Hernandez de Coz and Klaus Knott, both also speaking at this Riksbank event. Curious to see how they respond to the increase in yields in that region, given how significant the sell-off in bonds have been, given how much people have recalibrated with the optimism, and how much the central bank has to push against that to try to bring core inflation so much lower. And at 1 p.m., we get U.S. selling $40 billion of 3-year notes. A question here of what the demand is going to be like at a time when you have yields that are kind of meandering here. They really haven't gone up as much as the Fed would like to see. Do people start to buy the idea of that the Fed is selling and actually not come in to buy 3-year bonds with yields as low as they have gotten?
Lisa, great work, as always. The day ahead, some bond issues in the mix as well, Tom.
Well, there's been big issuance here. You wonder what CFOs are going to do into this. I mean, you talk about the uncertainty. What do you do with your weighting? You expand your weighting of fixed income here. That's a huge debate.
Great lineup this morning. Amy Wu-Silverman joining us now.
Yes.
Derivative strategist, equity strategist over at RBC Capital Markets. Amy, I want to start with your line, and you've got to explain to me what this means. This is setting up for a, quote, boy who cried market. Amy, what does that mean?
Yeah, it's setting up for a boy who cried wolf market. And what I mean by that is, we did kind of a post-mortem of 2022, obviously, just as we did our volatility 2023 outlook. And, my shocking stat is the drawdown on the S&P was 20%, guys. But what did worse was owning the S&P and buying puts. That was actually down about 21%. So essentially, you got the drawdown that you had expected, but you actually did worse hedging, and you actually did better off selling puts and owning calls. Yeah, so very counterintuitive market. And what's happened is people, they're not set up for any sort of downside. They're focused on a upside, up crash. And, that could be a boy who cried wolf market.
What Amy Wu-Silverman said there, folks, is incredibly important. We don't have time to expand on it right now. Look to RBC Capital Markets for that on the failure of hedging. Amy, well, I want to go to the reality, which is tech has underperformed. There's a raging bet that the weighting of tech in SPX will change. You look at the cross moments, the skew, the kurtosis, the variance there is Amazon, Apple, and the rest of the non-profitable tech fail. Tell us about the cross moments if we get a tech underperformance.
Yeah, look, I think this is hugely important, and I'm very fixated on this because, I'll steal this stat from Lori Calvasine, our equity strategist, but if you look at a contribution to return analysis, the vast majority of drawdown from the S&P last year was essentially a handful of companies. It was mega cap tech, and sure, the weight is shrinking, but it still has a long way to go. It's still half of the Qs. It's still, at least more than half of XLC and all these weighted ETFs. And as you know, volatility as a component of index weights is correlation plus volatility. So where that correlation goes matters hugely. If tech continues to shrink, that helps the S&P, but it doesn't help these other tech ETFs. And so that relative performance over this year is really, again, going to come down to kind of 6 or 7 names, what they do on earnings, what they do because of rates.
Amy, you used a phrase there, up crash, which I love because it's basically that the risk is that things are going to rally, not crash to the downside. What could drive an up crash in terms of where the leadership would come from in the S&P?
Yeah, in the same way, Lisa, that we talk about tech shrinkage, essentially the opposite of that. So if we get a tech reflation, a tech reweighting, because again, that makes these indices more correlated, that ramps up your volatility. And essentially, that's what investors are positioning for. Even if options investors tell you they're bearish, that is not reflected in the market right now. What they're really concerned about is we get a runaway rally and they haven't participated at all. So, in the next few days, we get, again, kind of better than expected data if earnings comes out better than expected, which is, contrary to what we've seen these last two earnings cycles, where you've had massive downside beats. That's when I think, you worry about this up crash, and that's what investors are focused on.
So, Amy, just quickly, what's your favorite trade right now going into earnings season?
The second most well-performing strategy in 2022 was flies. So butterfly strategies, which are essentially very high payout, very low premium strategies. I think those continue to do well when you have events ahead, like earnings. And I like those, again, on kind of the tech ETFs, because that's where the correlation punch is the highest. So something like Qs. Those are the kind of trades I think are attractive right now.
Looking for some big moves. Amy Wolf-Silverman, thank you.
Is there enough jargon there?
Capital Markets.
She spiked the jargon meter.
I was getting the dictionary out for my derivatives work. Amy Wolf-Silverman is fantastic. What Amy said there, Tom, I think is so important, though, with regards to what people say versus what they do. And sometimes there's a big spread between what they tell us and what they're actually doing.
Yeah. My quote of the year last year was from Nassim Taleb, who helped invent all the jargon that Wolf-Silverman studied. And the answer here is these are the subtle movements of whichever probability distribution you believe in. It can be a bell curve like the height of your high school class. It can be traditionally what's called a log normal curve. Taleb focuses on a strange one called the Poisson distribution. Forget about that. The answer is the adults on Wall Street are looking at these nuances. She says with tech, it's an important study.
And to make it super simple, overwhelmingly, the takeaway from that seems to be that investors are positioned for upside risk just in case there's a runaway rally they're not a part of.
And basically led by tech. People did not get rid of their tech bets, and they're basically doubling down that they're going to get a reprisal of the gains that they previously saw.
That's the single most important thing we've heard today, except maybe that stunning 6% China call. Really important, Lisa, that they still have a belief in what Mother Apple will do.
And that's what they're doing, not what they're saying.
We've had some big calls this morning, haven't we? And one of them was from Max Kentner of HSBC. Yeah. Max was bearish for the whole of 2022. And then we enter 2023. It is January 10th, and he has become constructive. Max Kentner is going to join us next, the Chief Multi-Asset Strategist at HSBC. That conversation on Bloomberg TV and on Bloomberg Radio in about 5 minutes from now. Look out for that conversation. Look out for Chairman Powell. He'll be on in a couple of hours' time, Tom.
We don't have it yet. We may get a positive Bloomberg Financial Conditions Index. 3 weeks ago, that was impossible.
And just to be clear, is that easing or a tightening
that is
of financial
accommodation
conditions?
That Chairman Powell does not want.
Will Chairman Powell push back a little bit later?
He will.
At the Riksbank?
100% certain. Mary Daly told me.
Mary Daly told you? When did she tell you that? In the diner?
Over coffee.
In Jackson Hole, Wyoming?
Yeah.
A number of months ago? Okay.
It wasn't the diner, it was the bar.
It was the bar, okay. All right, just to clarify.
We had.
What time was that?
Fernand Branca. That's what
10 a.m.
That's what they drink in San Francisco. Fernand Branca.
Tom was at the bar.
Mary was closing the bar. She goes, we have to have a San Francisco drink, so they pulled out a bottle of Fernand Branca.
Don't start rumors.
And she's my favorite. Full disclosure, Mary Daly is my absolute fave at the Fed.
I thought we didn't do favorites.
I do favorites. Mary Daly has a handle on America like no one.
Mine was Esther George, and now she's leaving.
Yeah, it was Esther George, but she took the dog. She took transitory with her.
From New York.
Pivot. Pivot was a puppy.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. A Singh cooperation deal would leave Bankman-Fried even more isolated. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. Now, the measure is not expected to pass once it's sent to the Democratic-controlled Senate. Crypto exchange Coinbase will cut about 950 jobs as it tries to weather a slump in the industry that's lasted more than a year. At the end of December, the company had more than 3,700 workers. Coinbase says the restructuring will be substantially complete by the end of the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What Fed is indicating is that they are willing to put up with a lot of pain, and some of the data from the payroll data gives them additional impetus to stay elevated and much longer, and at the risk of significant slowing in the economy. What is important to me is how long they stay there.
That's the big question in 2023. For those of you following the Federal Reserve, that was Vishy Tripatur, the Global Director of Fixed Income Research at Morgan Stanley. Let's get straight to the quote from Max Kettner of HSBC this morning. He makes a shift for 2023. We were staunch bears for much of 2022. Our previous view was that a recession would hit in the first half, and as such, markets would move into classic risk-off mode. We think it no longer holds. The sequencing of a bad first half and a recovery in the second half, it's likely to be reversed. Tom, there's a man for the whole of 2022 who was max underweight equities, and now all of a sudden, starting January 23, makes a shift.
It's a huge shift, and it's a shift from a house that's been very supple and very nimble. All of these houses matter, John. We talk about Morgan Stanley, where they invented fractious debate. HSBC has almost a kinetic energy going back 30 years with Jonathan Anderson in Asia and with others. And HSBC, you know, the people we know, David Bloom used to be there, and Steve Major, and that.
I miss Bloom.
There's almost like a frenzy to it. And Max is the legacy of that.
Don't forget friends of the program.
Yes. Well, I can't remember everybody's name. I mean, you know, there's Lisa.
Love you too.
Grandma's going to start throwing things at you.
She's going to throw do it on camera.
They've removed all objects from my seat. Carry on, Tom.
Let's go on now to an important conversation for Global Wall Street. Mr. Kettner with us, Chief Multi-Asset Strategist at HSBC. Max, John's got a lot of important questions. I'm going to do this simple. How do you dovetail your shift into Steve Major's call for low interest rates?
Yeah, good morning, Tom. I think it's probably the key question is really around the sequencing, right? Not so much where the end result is going to be. I think it's really a sequencing question. And with this really, really pessimistic, these pessimistic outlooks that we got both from the sell side and the buy side in the last couple of months, I think there is a very, very strong consensus. And it is my feeling that it's probably the most concentrated consensus that we had ever since the end of 2017. You may remember back then we had this idea of globally synchronized growth that really then went horribly wrong in 2018. And I think that's probably as much of a concentrated consensus as we've got right now. So therefore, what we're saying is that actually, against the backdrop of such a concentrated consensus, there's simply a lack of downside catalysts, a lack of downside surprises, and therefore the only way is up.
So, Max, let's talk about that. So, your words, super depressed growth expectations are key. Is there any evidence, Max, here that those growth expectations are captured in the price of markets right now?
Yeah.
And where you're seeing that?
Yeah, I think so. I think when we look at market pricing, so we look at things like equities versus rates, we look at equities versus rates against PMIs, or equities versus fixed income, comparing that against break-evens, so cross-asset relationships, or cross-asset against macro relationships. All of that looks a bit more realistic now. And I think one thing that I would say is it's not like we're super bullish, right? It's not like I'm saying, growth is going to go through the roof and it's going to be rock and roll. The only thing I'm going to say is, well, it's not going to be a Rocky Horror show, right? So that's the only thing that I'm saying. That basically, we're not going to see such extreme pessimism and against the backdrop of such extreme pessimism. You don't need an awful lot of positive surprises, right, to really make risk assets get going a little bit to the upside in the first half of the year. It could change in the second half of the year, right, when the ultimate level of inflation perhaps then is a bit sticky than thought. But, that's something for in 6-9 months' time, not something to fret about right now.
Why do I get the feeling you practiced that line a little bit earlier this morning?
100%.
Sure?
100%.
Definitely. Max, let's finish on this underweight in cash that you did have. where are you allocating that capital? Where does it go? We've had some big calls this morning on China reopening, Morgan Stanley one of them. On the Eurozone, Goldman dropping its recession call. Where does that cash call go now?
So it's not going into full-on overweight equities yet, right? So we haven't been as crazy as going from max underweight equities to max overweight equities. So we're sort of dipping our toes. We're going into IG credit, into high-yield credit, into emerging market debt, right? So really sort of dipping our toes into risk assets. It's still a preference of value over growth, right, in equities. So we still actually like European equities. We like European equities more than US equities, really like also EM and Chinese equities now. So I do think, against the backdrop of Chinese reopening, still a bit of underlying pessimism around Chinese growth, right? So we've just heard a bit of a pretty bold call around China growth early on in your program, right? That's starting to happen now. People are starting to drop recession calls for Europe and for the Eurozone. All that really should be continuing in the next couple of weeks. And as that reappraisal really continues, that should be beneficial for EM equities and for European equities.
So what's on the other side, Max, with the Rocky Horror Show potential that you were talking about for the first half that seems to be pushed out? What are you looking for to determine whether you should go back into your defensive haunch?
Yeah, I think the defensive haunch is probably towards the second half of the year. Once we've seen the negative rate of change in inflation play out, which is really probably going to be happening over the next sort of 4 or 5 months, right? Then we're suddenly going to start seeing, okay, now the negative rate of inflation is in the rear mirror, right? That's the rear view. Now we've played that. Now let's talk about the ultimate level of inflation we're going to stay. Does the Fed have to, does the Fed and other central banks have to keep rates a little bit higher for longer? Do the cuts first have to be priced out? And that then could be leading to perhaps an accident on financial markets or a retightening of financial conditions via higher credit spreads, lower equities. That's then something for the second half of the year. Once that focus shifts from initially now the negative rate of change in inflation, so the delta in inflation, to the ultimate level of inflation where we're going to end up at.
Do you think that the ultimate path for European equities is actually more positive than you previously thought because of this de-emphasis on U.S. tech? Basically, that, yes, there might be a downturn, but the optimism around Europe is sustainable.
Yeah, I think so, especially against the expectations, right? Let's remember, there's two things that we do in markets. We trade the rate of change and we trade data versus consensus, right? We don't really care where the data is per se. We care about how it pans out against consensus expectations. And I would argue, 1.5, 2 months ago, there was barely any bull to be found on Europe, right? So that's not long ago. That's just starting now, right? That shift is just starting. So I would really expect there is a bit more, more positive, a bit more of a positive run to go for Europe, both on the credit side, on FX, and on equities.
Wow, Max, great to catch up, buddy. Thanks for jumping on with us. Max Kentner there of HSBC, putting out a note that got a ton of attention in the last couple of hours. Bramo, it is January 10th and we're already getting pushback against the consensus. What's going on?
Yeah, I love it. The second week, we get an overhaul of what was established just a couple months ago. It gives you a sense either of how quickly things are moving or how quickly price changes the thesis.
Do you get the feeling that a lot of people are going to follow Max Kentner and HSBC?
100%, because you're feeling it already in the price action. You're feeling it in some of the rationale. And you put together a bullish China call, and you put together some of the bullish European calls, and what do you get?
How different do you think the conversation is, Tom, at 8:31 Eastern Time on Thursday morning when we get CPI? I mean, I've got no idea what that CPI print looks like.
I think it's a lot of ex-ante, hot air, MX post. I'm waiting for the data. And as I mentioned last week, retail sales next week will be watched. I mean, the Happy Valley will come to a halt for U.S. retail sales.
We were told it was all about the earnings, and now all of a sudden it's all about China and China reopening. That's become the number one factor.
I would double, to Mike Wilson's credit, I would double barrel them. But on a global basis, the China reopening and to get the scale out above 5%, for them to clear their real estate market with that fiscal input that you talked about would be extraordinary.
Max Kentner spoke to it. That call from Evercore, 6 handle on GDP growth in China.
I mean, they can manufacture it if they want it. That is the theory, and they seem to want it.
When do we start to question that China gets what it wants?
I think when we start to see the actual mobility data.
They get what they want.
The mobility data and the COVID progression.
Okay. Zach Griffiths of Credit Sites coming up shortly. Equities a touch softer yesterday, down just a little bit. Chairman Powell coming up later this morning. Going into that, equity futures right now down just a little bit again. We're down 17 on the S&P. Futures softer by 0.4%. It's emotional, Tom.
Yeah, it is.
The Nasdaq 100 down by 6 or
It's a
7
vulnerable
tenths of
market.
1%. You think it's vulnerable?
Vulnerable market.
I don't think this bond market's been vulnerable the last couple of days. We've had a move of 25 basis points at the front end on a 2-year, lower. Today we're trying to bounce up 4 basis points on a 2-year to 424.93. I think Lisa's asking the right question. If Chairman Powell speaks later, will this market listen?
No way. I mean,
have
come on.
we been processing the Fed speak over the last couple of days?
Honestly, is this a market that hears what the Fed is saying, which is that we're going to be hawkish? I'm not a pivot guy. We're going to get to 5.25% and hold it for a very long time. Is this market recognizing
Responding to the data, isn't it? Softer wages, survey data sub 50, and just saying, I don't think you're right.
Yeah, well, maybe they're right. I don't know. We'll have to see, honestly.
We will. We'll have to see on the euro story as well. Euro dollar shaping up as follows this morning. 107 handle, holding on to it, unchanged on the session on that currency pair, 107.30. If you had a look at the FX market in yesterday's session, pretty much everything stronger against the US dollar in G10, pretty much everything stronger against the US dollar, Tom, in Asia. The Korean won absolutely flying. EM equities back in a bull market. Everyone bulled up on China reopening and seemingly a little bit of optimism around Europe too, with Goldman dropping its recession call.
When's the last time we talked about Korea? Korea is a unique in that it's considered the most American of the economies over there, the most open, the most fluid on a philosophical basis, the most lock-in. And the answer is the Kospi. Their equity market has been traditionally the roulette wheel of Asia. That's where you get beta. That's where you get play. And the Korean won is very supple, not only dollar won, but the cross rates to Korea and the Pacific
Well,
Rim.
let's take dollar one. Dollar one in yesterday's session, Lisa, lowest since last June. So some one strength really kicking back in and just dollar weakness all over the place.
Especially with the reopening of China and suddenly this feeling that perhaps the rest of the world is going to fare better. I'm looking at some specific stocks that are moving just in terms of the zombie roll-up that Tom talks about. Here's a zombie roll-up in the healthcare industry that people are looking for, although I don't want to call this acquisition target necessarily a zombie by any means, but you are seeing consolidation. Oak Street Health shares surging more than 35%. CVS is exploring an acquisition of this. And basically, this, again, goes to consolidation of among the strongest players that we're potentially going to see, pretty broad-based. HP Enterprise, interesting to see weakness across the tech space, down 2%. And this comes after the Taiwan semiconductor space actually posted a disappointing profit. This, to me, fascinating, ongoing weakness and projections from the tech sector amid a lot of concern about what could potentially happen. And Bed Bath & Beyond, those shares, I mean,
Why are they in the news today? What's the so what?
They're going to report earnings, and they're going to have a call at 8:30 a.m. They're actually fascinating as some of the details come out about what happened with them. Basically, their suppliers went on strike. They didn't believe that they were going to be able to get them their money back, so they increased the credit terms. So Bed Bath & Beyond, if you're going in and seeing empty shelves, it's because they couldn't get the supplies, which I find really interesting.
I'm glad you do this quickly, Lisa. Oak Street Health, I wasn't aware of. You know, you go to a weighted average cost of capital. It's sort of responsible and grown up in that. And they've gone from 60 to 20. The shares are cratered along with other non-profitable companies. I'm looking at the income statement, and the big difference with Oak Street Health is it's a whole new world after all for them. Money costs something. And they're looking at negative EBITDA margins, negative net income. Revenue growth is snappy, no question about that. What do? You find somebody to help you. And that's what we've got this morning.
Have you ever watched Undercover Boss? You ever watched that program?
What is it?
Undercover Boss. Have you ever watched that program?
Undercover Boss?
I'd like to see Tom go and do Undercover Boss, but as the boss of Bed Bath & Beyond or something like that.
That would be very
Wouldn't
interesting.
that be cool?
That would be very
I
cool.
think 20 years ago, given the free money, Undercover Boss would have said,
I don't think he could ever
shut
go
it
undercover.
down.
I just wonder how they'd disguise him.
He'd wear
and what
sunglasses.
they disguise him as.
Yeah, exactly. I mean, I don't know.
John from York was talking about me being an undercover boss for Bloomberg TV and Radio.
Oh, really?
Yeah.
What would you be disguised as?
They said, no, I don't think so.
Would you like to put my microphone up?
No, you know.
Okay.
Just,
Is that what you do? Sort of get the mics ready and
get the
work the studio floor?
Yeah,
You'd be good at
fix
that.
it up.
That was my first job. I was terrible at it.
Really? You did
I was
that?
shocking at it, yeah. They said, get on TV. Not
Do a
doing
good
that.
job.
I mean, that story's pretty close to the truth,
We're going
to
to
be honest
continue
with you.
now and save ourselves. Zachary Griffiths joins us, senior fixed income strategist at Credit Suisse. And so what's so important here is he parses out in a very short space segments of fixed income. Lisa Abramowicz knows this, and Lisa, he leads with distress is the place to be.
Yeah, the place to be, not to avoid, the place to go into. And this is the shift that we've been seeing pretty consistently, Zach. Given the fact that we're looking at a situation of a potential downturn and central banks that are determined to stymie growth, why are you getting long high-yield bonds?
Yields look too good to be short. And when we look at the scenarios that we expect for 2023 and kind of balancing those out, we think that the potential for returns in the 12% area really make high yield an attractive place to be. And we're also more optimistic on the economic front, which is very important for our call for high yield as well. We think that we are able to avoid a recession in 2023. We have growth fall to well below potential in the 0 to 1% range, but we don't have that recession that's driven by our Fed funds call, which is more dovish than the market expects. We think you're really seeing a turn in inflation over the past couple of months, which is set to continue. And the Fed has acknowledged this. Now, I recognize that the messaging certainly this week has been more hawkish. We think they're going to remain hawkish, at least on a forward guidance perspective, until they're fairly certain that inflation is coming sustainably lower. We think that's coming sooner than the market expects at this point.
A couple of years ago, Zach, people were saying that if the central banks decided to abandon some of their low-rate policies, it would be Armageddon in credit space. You'd end up with defaults skyrocketing. You'd end up with companies unable to finance themselves after existing on free money for so long. Why are you saying that that entire scenario is just wildly wrong and that actually high rates is going to lead to a really good scenario for bond investors?
It's been incredible how much the market, or how well the market has held up so far, I'd say, with just such an incredible move. If you look at the move in real rates, it's been just so substantial. And I think, going into 2022, many thought that the market, whether it be credit or equities, wouldn't be able to handle it. Now, 2022 is certainly an awful year from a total return perspective, really across asset classes. But we think the balance of risks are a little bit more balanced than what the market is suggesting at this point. And so when you think about where yields are, just how good economic fundamentals are and fundamentals for companies coming into 2023, we think that yield risk perspective really favors going into high yield credit. And we think that these credits can withstand higher yields at least throughout this year.
Tell me about energy and credit. And energy and high yield has always been the challenge. I think energy was doing well at $100, $120 Brent crude. We're not there now. Is energy challenged as they refi high yield?
We have a bit more of a balanced outlook for energy in the high yield space. We had been more constructive throughout 2022. I think as you have seen energy prices come down, it's going to be less of a tailwind for the energy market. So we are market perform on high yield energy in 2023, and that's a big factor, Tom. So we think that it could hold up decently well in this market, as we think that economic growth remains at least positive throughout this year, but we don't have the full-throated constructive outlook that we had in 2022.
Zach, I want to go all Common and Tversky with you and talk about regret. 12 months from now, if we get a bounce in the annihilated Bloomberg Total Return Index, price up, yield down, are we going to regret missing that? What's the magnitude of the bounce we could get in the total return index?
We think it could be substantial. Now, we are expecting yields to remain elevated throughout 2023. We think the 10-year Treasury yield is heading back to 4%. And so I think we're in more of a buy the dip territory from a purely duration perspective. And it's going to be interesting to see what happens with CPI this week. That's certainly a huge figure going into the FOMC meeting at the end of this month. We're expecting just a 25 basis point rate hike and think the Fed might even be able to pause from there. Now, the timing perspective of that is what's going to be very difficult. We've been looking at different inflation scenarios and think it could be coming back toward 2% by the end of 2023. We think the Fed has recognized that, but messaging so far has been quite hawkish this week. It'll be interesting to hear from Chairman Powell later today.
Zach, just to be clear here, just to clarify what you just said, coming back towards 2 at the end of 23, does that mean they think it's going back towards 2 by the end of 23, or you think we land at 2 by the end of 23?
I guess both, John. I think that the Fed has recognized in several adjustments to the policy statement. I'd say the FOMC minutes recognize that the risks are more balanced than they have been for quite some time. And so we think that the Fed is looking at inflation on a forward basis, and you're really starting to see that goods disinflation now. And we think the services disinflation, especially from shelter costs, is coming in the second half of this year. So as they calibrate policy over the next couple of months, we think those two factors are going to be crucial, and they recognize those, and that's going to be what emerges over the next couple of months with a policy pause, not a pivot.
Well, there's a call. Zach Griffiths there of Credit Size. Zach, that was great. Thank you, buddy. Thank you very much. I mean, we joke about everyone being consensus, but wow, we've had some calls this morning. Another 25 basis point hike and then a pause. That's what Zach's talking about. Convinced of getting back to 2 maybe by the end of this year.
Rapid disinflation that actually is sticky. And how does that fit into the labor market story that we've been hearing from economist after economist with a structurally tight labor market? This is sort of the conflict that's inherent in a lot of the market calls.
Alan Blinder writing on this in the Wall Street Journal, and Olivier Blanchard, folks, will join us in an hour. Professor Blanchard with my essay of the year, no question about that, a new book out. And, Olivier Blanchard says, stop sweating this 2% silliness. Just bring it down to what, 5 to 4 to 3 at imposing 3%.
They're going to change the target. Is it too early to discuss that?
Just the fixation with Powell today will be 2%, 2%, 2%.
What's interesting about this conversation today is it is on central bank independence. That's kind of interesting, right? At a time where they're saying,
particularly the heritage of the Riksbank.
At a time when they're saying unemployment needs to go up, and I'm sure many people, elected officials, wouldn't like unemployment to go up. I mean, this is they would say that this is why we need independence, because we've got to make these hard decisions that politicians wouldn't make to make sure that inflation is low. And I think a lot of people would respond and say, well, what happened last year and the year before?
I wonder, though, with Fed credibility, it's one thing to talk about independence. People don't believe them. People don't believe that they're going to stick to their guns. People don't believe that they're going to go against what an economy could potentially do in terms of higher unemployment.
Can I segue?
I don't know what you are.
I mean, honestly,
if a different nation or a different royal family decided to buy the Boston Red Sox or the Los Angeles Dodgers, this country would be apoplectic.
Okay.
Explain the culture that World Cup Qatar and the family there can look at, I believe it's Manchester United, Liverpool, or dare I say even the Spurs.
Yeah, it's attracting a lot of capital, the Premier League is.
Am I right? Newcastle was taken out by a Saudi portion?
Yeah.
Is it a Middle East takeover of your sport?
I think there's an American takeover in the mix as well. Of the
I'm just doing this because I want to go see Fulham and Tottenham.
Fulham.
And, I thought it was Fulham.
You're looking for a full hand.
Are you trying to come up with a reason to go to London?
You got that right. I don't give a damn.
You sniffed it out.
Mr. Levy, I don't care about the future of the Tots. I just want to go see you in Fulham.
Fulham.
Oh, excuse me.
He wants a full hand.
Oh, God, you're killing me.
Having too much fun, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, the UK's attempt to send the first satellites into orbits from its own soil has failed. A rocket launch from a Virgin Orbit Boeing 747 that took off from England malfunctioned. Now, that led to the loss of its payload of 9 satellites. The jumbo jet and its crew did return safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order for the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. China is striking back at countries for imposing COVID-related curbs on Chinese travelers. Beijing has suspended issuing some visas for South Korea and Japan. It's China's first attempt at retaliation after a number of nations implemented testing requirements for travelers from the country. BMW outsold rival Mercedes-Benz for the second year in a row. Worldwide deliveries of BMW-branded cars fell 5% to 2.1 million last year. Meanwhile, Mercedes shipments were down 1% to a little more than 2 million. BMW did a better job with dealing with supply chain issues that hampered auto production. And in college football, Georgia has won its second national championship in a row. The Bulldogs pounded TCU 65-7 in a game that was more or less over before halftime. Georgia quarterback Stetson Bennett threw for 2 touchdowns and ran for 2 others. I'm Lisa Mateo. This is Bloomberg.
whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done. We need to go ahead and get it started from an equity market perspective. Markets really can't handle that. Will we, won't we? Will we, won't we? They just want to know. They just want to rip off the Band-Aid and get back to business.
Clear the decks, rip off the Band-Aid. That's the message from Lori Calvasina, the head of US equity strategy at RBC Capital Markets. Will we get that this earnings season? JP Morgan reporting numbers this coming Friday. Before we get there, it's CPI on Thursday and Chairman Powell a little bit later this morning, about an hour and 15 minutes away. Going into it, equities turn lower by 0.7% on the Nasdaq. Tom, on the S&P 500, futures here softer by 0.5%, and crude just about holding on to $75 a barrel on WTI, on a session at least, up by 0.5%.
Interesting day, to say the least, and wrapped around all of this has been oil. John, would you say with a lift here in the last 2 weeks or so, getting about to start to 80, 81 on Brent crude? We're sort of there now.
It was an odd start to the year, let's put it that way, with regards to the commodity market. But certainly the calls are coming through, Tom, and a more optimistic view, again, off the back of a China reopening story.
We'll reframe and reset now. We do this with Ellen Wald, senior fellow at the Atlantic Council. The rarest thing in a story, and that means she's read Daniel Yergin, the prize, cover to cover twice. That's what qualifies her to be a oil historian. Ellen Wald, I want to go to your acclaimed Saudi Inc., your knowledge of the royal family of Saudi Arabia. They're in the news. They're in the news on geopolitics. They're in the news with Mr. Putin. Maybe they're in the news with President Biden as well. What are you studying about the Saudi family early 2023?
Yeah, I think that the question for Saudi Arabia for really this year is, are we going to see any big shakeups in terms of the line of succession? Are we going to see MBS move into an official position of power? I'd say I think that they're probably going to keep things status quo for this year, unless obviously there's some kind of health crisis. But that's really probably the biggest source of instability that could face them now. Oil prices are generally not really a source of instability for them.
How do they fit into the Levant, from Erdogan and all his desires up in Turkey over to in Iran, which is, falling apart is maybe too harsh. But how do they want to be a regional player with their marginal oil power?
They definitely want to be a regional player in the biggest sense. I think for a long time, they were content to really be kind of the source of money and also the source of religious authority, and to kind of play that role, not so much in the kind of big, flashy media sense, but really just as the kind of the soft power, both religious and in terms of money. But now I do think we're moving into a phase where they really want to be out there as, the guys doing the big business deals, the source of the biggest and the best and the flashiest. And I think that that's really a new look for them. I do think that the younger generation, that this resonates with them, but there are definitely a lot of people in Saudi Arabia, older or more conservative types, who are much more hesitant to really see themselves as kind of out there in the front, making the big splashy media pages, and they're not very comfortable with that.
Let's talk about where those big deals might come from, and the China reopening that we've been wondering about for so long in terms of its influence over crude markets. Why is there not more optimism or perhaps pessimism, depending on which side of this you're on, that China's reopening will cause a huge increase in demand and push up the price that we're seeing in crude markets?
Yeah, this is a really good question, and I think it's definitely the number one question on the minds of oil traders and kind of everyone who's wondering about oil prices right now is, when are we going to see that big jump, that big surge in Chinese demand from the reopening? And I actually am kind of thinking that we may not see a huge jump or a huge surge. It may be more like a slow kind of a slow push upwards, a slow curve upwards, because I'm not sure China's going to react the same way that Western economies have. We may see a lot more hesitancy on the part of some parts of the Chinese population to jump back into flying and driving and going around. So I wonder if we're not going to see that, though. The real question is, who would know? And I think that the Saudis would probably be the first to know what's going to happen with Chinese oil demand, because they've got oil deals from, here to there with Chinese refineries. They're a huge source of oil. Yes, so is Russia, but Saudi Arabia's got the long-term deals. And so I would say that they would probably be the first to know from the Chinese government when they think that oil demand is going to start going up. And we may see some movement in terms of the price that Saudi Arabia is selling oil to China, or the amount that they're selling to China, moving before that surge upwards.
If there isn't a surge upwards in demand from China's reopening, where does that send oil prices? Do you see them even going lower if this warm weather holds?
Well, I think the warm weather is definitely helpful, but I do think that once we hit, summertime, that warm weather will cause a surge in oil demand. And I think that, if we don't get a surge upwards, but we do see kind of a slow trickle upwards, that all of a sudden a day will come when we're like, wow, oil demand is huge now, or we've finally hit that that mark, but no one really necessarily saw that giant jump. That could change, though. I mean, the Chinese government has its ways of kind of compelling people to do what they want, and they may kind of push the population in that direction.
Now, let's go all Excel spreadsheet. Where's oil going to be in a year? Do you buy the bulls that talk of 100, 120 a barrel? Do you buy the story?
I don't make forecasts because I think
it's TV. Nobody's listening. Come on, Ellen. Don't go to pennies. Just give us a dollar level on Brent.
That's the real issue.
I'll say that 120 is definitely a possibility, though I don't see that as a sustainable number.
That's how you do it.
See how she nailed that?
You say something's possible.
That was an interview for. I think that Jeff Curry needs to hire her. That's all there is to it.
Ellen Wald. Ellen, fantastic. Thank you. Ellen Wald there of the Atlantic Council. What do we always say? I said it yesterday. How do you make a fool out of someone? You ask them to predict the oil price 12 months out.
Or when. She was the amateur that she said a year out. Yeah.
So hard. It's so hard. It's ridiculous. I mean, based on what's happening in China, who knows what that's going to look like by
It's
year
like
end.
predicting what inflation will be Thursday.
I wonder if people are going to have an outsized reaction to whether or not Saudi Arabia or OPEC Plus decides to cut production or to increase production, to look for the tea leaves of their knowledge of what China's plans are. Because if, as Ellen Wald was talking about, there are discussions about what China's really desiring in terms of seeing mobility among residents, that could change the game.
Where did she go recently?
He's been all over the place.
Went to Riyadh, didn't he?
Yeah, he went to Riyadh, but he's also been,
this goes back to Robert Lacey and the great work by Ellen Wald and Dr. Juergen and others. What's irrefutable is a generational shift in Saudi Arabia. There's no question about that. And that,
And that's come with some tension.
Huge.
Riyadh, DC. That's
tension.
come with some real tension.
Yeah.
Over the last 12 months. Have we resolved any of that? Because it was pretty fiery going towards year end.
I just don't have the knowledge base on it. I would say it continues into this year is where I would sit, and particularly the relationship with the White House.
Do you remember that odd moment going into that OPEC Plus meeting? And the Saudis came out the other side and basically accused the administration of asking for a delay until after the midterms?
Yeah, there was not exactly a meeting of the minds.
Pretty blunt stuff, right?
This wasn't exactly a fist bump that got any particular leverage.
No, and I wonder how that shapes up a little bit later this year. What's happening with refilling the SPR? That's turning out to be more difficult than expected, right?
People are saying, or the administration signaled that they would start refilling it by February of next year. And potentially, if they do refill it without moving the markets, it'll be considered a win for them because they basically sold high and bought low. But there's a question of whether they can refill it enough and what that does to the pricing, right? I don't understand the dynamic and how much that could potentially push prices up if they're buying.
Who do they buy the oil from?
So here we go. We've got the administration are basically saying we buy around 70. Is that right?
Right.
So we've got this floor of 70 with the administration basically saying we're ready to buy.
Right.
And then you've got China reopening. So what's the floor for crude this year?
I mean, you've got to imagine that it's got to be 70, if not more than that, right?
I'm asking, I'm trying to work it out.
But the question is, does it go to 75, 78? Do they start kicking it up a little bit as they try to prepare? Does it get away from them? Do they have to come in? All great questions. If they plan to start refilling it in February, do they move away if it isn't that 70 handle?
$80 right now, there and thereabouts on Brent, 79.91. About an hour and 5 minutes from now, you hear from Chairman Powell. Bit of optimism out there this morning. In fact, I'd say a ton of optimism around the Europe story. Guess who's going to weigh in? James Athey of Aberdeen, Tom, Investment Director. Your favourite firm. How do you pronounce that?
It's like the tots. The tots would be the.
I can't believe that they changed their branding of Aberdeen.
Spurs would be Spurs.
They need to get
They
some
dropped the vowels, and I thought it was a joke
vowels.
the morning they did it.
Yes, we all did.
And they've committed to it.
I'm in that camp.
We're just like
James Athey's a good sport. I mean, he'll go along with it. But every time I ask anyone at Aberdeen, is it changing anytime? They just look at me like, John, just shut up.
You mention that one more time, I walk out.
You don't want to talk about it. James Athey.
I think what we're in for is an awful lot of choppy trading as the market reacts to the ebb and flow of this very volatile news flow.
The bond market has been so choppy, so volatile now for really the past 6 months.
We have to get used to an inverted curve all this year, in our view.
A sustained, deep yield curve inversion is not a soft landing story.
To me, a soft landing is a landing you can walk away from, and I think the economy is strong enough right now, at least it looks like that it'll do so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Neela Richardson out front of the Optimism today. And, John, it is Optimistic Tuesday.
Is that what you're calling it?
I'm calling it Optimistic Tuesday on the way to Inflation Thursday.
Let's see if that optimism holds going into Thursday morning at 8:31 Eastern Time, 60 seconds after that print. But sure, so far, so good. Goldman says no recession in the Eurozone.
Euro moves.
They drop their call. Morgan Stanley comes out and says we're underestimating the impact, the positive impact of China reopening. Good news. Max Kettner, about an hour ago on this programme of HSBC, has changed his view. He was downbeat on risk assets last year. He's upbeat now.
Right. Let's go to the thermometer, Lisa, very quickly here. The spread market, spread market is the thermometer for equity participants. Does it suggest an optimism?
Yes, it does. It's been ripping. If you take a look at high-yield bond spreads, they're at the lowest levels going back 3 months. I mean, basically, you saw a huge inflow into the most speculative of credit, of corporate credit, because people believe that companies will, to use somebody's term, adapt and adjust and move forward. And this is the issue, right? It's sort of counterintuitive because everyone was calling for Armageddon when rates rose.
I mean, and it's about earnings. Mike Wilson made it very clear he's earnings-centric, but so many others, John, combine that with the inflation call globally.
He thinks the earnings are going to be dreadful, and there could be as much as 20% downside plus in this equity market. Look, Tom, we came into the year, and I think it was the managing director of the IMF, Kristalina Georgieva, that said the global economy is in for tough times. High-yield spreads are tighter, EM's ripped, the dollar's weaker. That doesn't scream tough times at the moment, does it?
In this hour, Olivier Blanchard with my essay of 2022. He will join us. Thrilled by that with the Peterson Institute. And, John, this is the whole debate of if we get disinflation, what does it do to Mike Wilson's world if we don't get to the vaunted 2%?
Well, Lisa's good on that, and it becomes a margin story, doesn't it, Lisa, pretty quickly?
That's exactly where I wanted to go. You can read my mind. Lululemon. And this, to me, is really the question, that even if you get disinflation, even if you get this positive economic data, what does this say about consumers perhaps pushing back on the margins against prices going up? And I really don't think that this has been talked about enough. The Small Business Optimism Index, I'll get it out. Small Business Optimism coming out at the softest reading, the second softest reading going back to 2013. It surprised to the downside. So there isn't necessarily optimism everywhere.
Okay, I want to digress here. We're going to get this out of the way and check the box. Crypto will have much more on this afternoon. John, Dana Bass kills it with the idea of the newest vogue, which I really don't understand, is Chat GPT, which is artificial intelligence so Lisa's kids can do their homework.
I think it's amazing.
I think I got that right.
We'll talk about that in a moment. So let's talk about the news, and then we can talk about the homework issue. So Microsoft, according to people familiar with the matter, is interested in maybe investing as much as $10 billion into OpenAI.
In an idea that came out 90 days ago.
That's the creator of this bot. We understand from Semaphore, I think in the last week or so, that they could be valuing OpenAI maybe at as much as $29 billion. Homework question's fascinating because none of us had access to the internet in quite the same way the kids do these days.
We call it Cliff Notes, John,
to go
in
on
America.
there and get to cheat, basically. Well, Bremo, now I just wonder, can you go on and get a first draft from ChatGPT and then just edit it and then send it in?
So theoretically, this has been a discussion at home, and theoretically, this has been an issue in schools.
But can you tell us how it's working out in reality?
The way it's working out, it's not quite good enough for high school level. At this point, it's not quite good enough to pass as the kids' work. but they're testing it out every day, so maybe it'll get there pretty quickly.
For fossils,
and you have to wonder, what is the consequence going to be?
Bramo with the report there. The fossils of us are going to look here. A kid out on Twitter had this, and I thought it was absolutely great. You go to this silliness, artificial intelligence homework, and you can do the history of John Farrow's London. According to Dr. Seuss, you put that in, and John, you get once upon a time in a land across the sea, there was a city called London as grand as can be. It started as a small town by the River Thames, so wide, but it quickly grew and flourished with buildings tall and wide.
You missed your call.
I mean, come on.
You should read this up.
I think it's a great idea, and I'm glad your kids are cheating through school on this.
They're not.
John,
They're not getting away with it yet.
No, it's my kids that are cheating through school. John, $10 billion for the latest Vogue idea?
Well, think about how much money it could save, potentially, and how many people it could replace. Sam Rowe asked this question recently. Do you remember Sam, Business Insider, then Yahoo
Do I
Finance?
remember Sam Rowe? The only reason I got through
awesome.
CFA was Sam Rowe.
Sam Rowe was just absolutely awesome. And he asked this question on Twitter. What would your editor do if you were a reporter and you'd been filing first drafts that had been authored by ChatGPT, and they were pretty good drafts and they needed some corrections, but no more than the average editor would have to correct on any given day? What would they do?
They would fire the person and just use ChatGPT. I mean, this is the question, is at what point do you need the middleman? I mean, this is one of the search engines that you're dealing with Google. They're actually trying to use this kind of ChatGPT to get better results, but at what point does this replace
I mean, it's a new debate for
intelligence?
Wikipedia, or the debate of Google search and all that. It's technology overrunning the methods we knew.
The human touch, Tom.
It's a human touch.
Can't lose the human touch. I'm very
It's
emotional
just
about
sensitive.
In some areas you can.
So emotional about it.
You know, that was almost like a Peter Gabriel moment there.
You know, we're going to have a producer moment when one day a producer just goes on ChatGPT and just says, screw it.
See these guys. Let's do this. Let's do a mini data check. John, I'm looking at massive accommodation in the Chairman Powell's comments here in an hour.
Chairman Powell, about 54 minutes away. We'll see if he pushes back. It's a forum on central bank independence with the Riksbank, which I believe is the world's oldest central bank, Tom. And it's an opportunity in the Q&A. If he wants to push back, he can, but we'll see what the questions are. Futures on the S&P down about 0.5% going into this, and Tom, yields higher by 3 basis points, 356.51 on a 10-year.
James Athey joins us, always adding value with Aberdeen. Thrilled he could be with us today. James Athey, are we in a disinflationary trend?
Good grief, Tom. I'm so glad you didn't ask me about ChatGPT. I'm pretty sure, based on that little poem, that it'll be replacing me pretty soon. Yeah, Tom, I do think we are in a cyclical disinflation. I think the base effects are such a huge hurdle for the inflationistas to clear in the next 6 months. Even if we have an oil bounce from here, you're still going to have pretty negative base effects for a while. And I think, therefore, we're going to see headline disinflation. If we don't get another rise in commodity prices, I think that disinflation in the second half of the year will kind of filter through into core, and the picture will look very, very different. But, you know, you guys have already been discussing the China reopening. I think that's definitely the biggest and most obvious risk to my cyclical disinflation view. Secular inflation, I think there are some interesting arguments. I don't claim to have the answer there at all. For me, that's a question of levels and changes. Does deglobalization mean a higher price level, a kind of one-off move, or is that a ongoing sort of multi-year, decadal inflationary force? I'm not quite sure.
James, let's get to where this leaves Europe. You know the call from Goldman from a little bit earlier this morning. We no longer look for a Eurozone recession, reflecting better growth momentum, sharply lower natural gas prices and earlier China reopening. Would you go along with that based on the data you've seen so far?
I mean, you can understand how they get there. Obviously, the Goldman guys are much more bullish just in general. They don't have a US recession. Their view is that financial conditions operate a lot more immediately, I think, than conventional wisdom. So they think already we've passed the sort of peak impact of the Fed tightening, and therefore the jobs market has survived, and they're quite bullish. I'm not convinced by that argument at all. I think the delta that they've noted, you know, low gas prices is a relief for governments. It's a relief for government funding. It should be a bit of a relief for rates. And obviously China reopening is definitely a potential boon to German manufacturing and exporters across the region. I'm not convinced that allows them to avoid recession. I mean, if we do end up in a place where Goldman's is right and all of these economies avoid recession, even with this mammoth monetary tightening that we've seen, it really does raise some significant questions about what central banks have been fretting about over the last 10 years with respect to the damaging impact of tighter monetary policy, I have to say.
So are you going in the opposite direction? Are you hoarding cash? Are you moving away from risk in order to counterbalance some of the recent optimism?
I mean, Lisa, you and I are probably more biased to be on the miserable side than the others.
May we quote you on that?
I think it's interesting that I found my way onto the show on Optimism Tuesday because I'm not really known as an optimist. Now, I mean, I wouldn't have been cyclically positioned anyway. I think we're seeing lots of dead cat bounces, lots of bear market rallies, lots of Pavlovian responses, right? The market has just become so accustomed to the Fed ringing the bell, everybody salivates and buys risk assets. I think this is a different world. I think there's more of a secular decline in valuation multiples, particularly in the US coming. And more to the point, I think we are headed for a recession. And I think, you know, like Mike Wilson, I do very similar maths. I get to a kind of similar number, maybe. I think earnings of around $200 and an average PE of, say, 14 or 15, and you get to 2,700, 300-ish, 3,000-ish for S&P.
Well, James, that's the equity core in the US. How would you characterise the move in EM? Bull market up 20% since October. It's ripped.
Yeah, obviously, there's a couple of things there. One, obviously, the dollar's been weak, and that's generally good for EM. The other is that actually, in a lot of the kind of bigger emerging markets, we saw a much more credible response to the pandemic, both on the monetary and the fiscal side. You take an economy like Mexico, and you can't really see any deviation in their current account balance as a percentage of GDP, unlike the US, where it obviously blew out and has come back aggressively. And the monetary response was quite rapid, and it was quite orthodox. And so a lot of those central banks are more ahead of the curve. I think, therefore, there's a lot more in the price, shall we say. Equities look cheaper relative to the economic outlook. I still wouldn't be piling in myself here. I like EM local rates, to be honest. I think that's a more attractive story for me.
James Athey of Aberdeen. James, thank you. You should do a podcast with Bramo. Transatlantic. Wouldn't that be cool?
Yeah, just
what would you call it?
Simple, miserable.
Miserable.
Athey and Bramo, miserable. I mean, that's what I learned out of that interview.
Yeah, I'm sure so many people would listen. You know, I was actually thinking, what would be my response? And I went to ChatGPT to try to create one. But
what does it say?
It's at capacity right now, so I'm not able to create a response. I'm just sitting here in my miserable hovel.
Have you ever skied Piani di Bobbio near Lake Como?
No.
I mean, with the weather in Europe, the ski resorts are
you
really
go skiing?
No, you
he snowboards.
I used to. Used to is the operative. Hard boot snowboard.
Huh.
Yeah.
Didn't know that.
Did you do jumps?
Is it another life?
Half pipe?
Oh.
No, not half pipe.
Is one of us going
down
skiing?
the mountain?
Is one of us going skiing?
No, is one of us going skiing? Really?
One of us might.
I didn't. Not me. I'm retired.
ChatGPT.
No,
not skiing.
I'm not skiing.
Coming up, 8:30 Eastern Time.
I like it though. I mean, you know, Closters is better.
Nationwide.
Closters is better.
Are you doing that?
I like it there, Prince. You know, Closters is, you know, it's a distance. I'm probably staying there.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. The measure is not expected to pass once it's sent to the Democratic-controlled Senate. Attorneys for President Biden discovered classified documents while packing up the Washington office he used after serving as vice president. The White House says the materials were turned over to the National Archives. The Justice Department is reviewing the matter. Former President Trump is under investigation for his handling of classified materials at his Florida estate. Crypto exchange Coinbase will cut about 950 jobs as it tries to weather a slump in the industry that's lasted for more than a year. At the end of December, the company had more than 3,700 workers. Coinbase says a restructuring will be substantially complete by the end of the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
trading partners that are like us, Canada, U.S., and Mexico, who do enormous trade volumes. I mean, I would say that this is one of the most successful trading relationships in the world. The three countries have been trading together for 30 years. If I look at 2021's trade volumes, we've done nearly $2 trillion every single day. It's $4 billion of trade. So these are significant numbers in trade between the three countries.
That was the Canadian Trade Minister speaking to Bloomberg's Anne-Marie Jourdain as the three leaders get together in Mexico City from Canada, from the United States and from Mexico as well. The three of them set to announce a deal on climate goals, according to Dow Jones reporting just moments ago. We'll pick up on that with AMH in just a moment. We are about 40 minutes or so away from hearing from Chairman Powell. Going into all of that, equity futures are slightly softer by 0.5%. Yields are higher by 4 basis points on a 10-year, 357.44. As Mike McKee said to me yesterday, Chairman Powell talks sort of, because it's on central bank independence, and really what we're waiting for is the Q&A and hoping that someone asks a couple of pointed questions, Tom, about policy in the United States.
I don't know what we're going to see on the question line, but what we're going to see is a wait for Thursday. I would suggest, John, every day since the jobs report, every hour, that inflation report becomes more germane. Let's break that apart. Is it core or top line that matters? I would suggest both.
And then we get straight into earnings. We'll be knee-deep in earnings season by the time we get to Friday morning.
Let's assume that's negative. Let's assume there's a tinge there that's
based on
cautious.
Jeffries. Did you see the Jeffries numbers?
Yeah.
Better than expected.
Still pretty dreadful, though, weren't they?
Still pretty dreadful, but is it the absolute number, or is it the bar that they've got to cross, right? How much of the disappointment has already been baked in to what people have seen?
Well, for markets, as you know, Lisa, Tom, it's always relative to expectations, so we'll see.
Yeah, we'll have to see. I mean, there's just no question about it. Let's jump over now to Mexico City. Anne-Marie Jourdain traveling with the President of the United States. She comes to us in front of that iconic statue of Mexico City. It is over her left shoulder on radio, the Angel of Independence, and we speak to the Angel of Independence this morning on what's going on in Washington. Anne-Marie, the clumsiness of the Republicans and what Speaker McCarthy agreed to. Do we clear that mystery up today, next week, or never?
Well, it remains to be seen on what kind of fights we're going to see on the House floor. Obviously, one that everyone's talking about is when it comes down in the early summer, when it comes down to raising the debt ceiling. But he cleared a significant hurdle yesterday. He was able to get the rules package over the line, even though you had some moderate Republicans grumbling. One of them did vote no, Representative Tony Gonzalez, but Representative Mace was a yes in the end. So that was a clear hurdle for him. But we cannot be naive. He is very much so a weak speaker at this point, and he has almost given these insurgents in his party a veto power on him. Well, and what French Hill said, Representative French Hill, which I know, Tom, you talk to a lot, he said this really decentralized the power the speakership has.
This is fascinating, and let's use a phrase from the former president. These Republicans in name only, and quite frankly, French Hill may be, and I don't want to allude to that, but Republicans in name only, what is their power now after the theater we saw the last weekend?
Well, you're seeing a divided party. I mean, it was 20 rebels that were voting against McCarthy. The power is what they were able to negotiate with him. Two things. Obviously, the biggest is the motion to vacate, meaning only one single member could call for his ouster. It was the threat of that kind of vote that Speaker Boehner had to leave in 2015. The second big thing McCarthy did negotiate with, and this will be interesting really for our viewers, is a cut in spending, 130 coming off of the spending budget for 2024, wants to cap it at 2022 levels. This is why these centrist Republicans are concerned, because they're worried that's going to hit some of the defense spending.
How much have you seen a change in tone from President Biden based on some of the internecine conflicts and this question about what he can actually promise, what he can actually get done, with what authority in terms of getting congressional consensus behind him he has as he discusses with his counterparts?
Well, it's the second week in January, and President Biden is in Mexico. I think you'll see the president really lean into his foreign policy this year, because he knows that there is gridlock in Congress, and there's really not a lot he is going to be able to get done. Of course, there's going to be the debates on the must-pass issues, but we already know those must-pass legislation issues, like the debt ceiling, like funding the government, those are going to be very contentious, because obviously we have a divided government with the Democrats controlling the Senate and a thin majority of Republicans in the House, and the Republicans themselves are struggling to agree on basic matters like who should be the speaker. So I think you're going to see Biden really lean into foreign policy, something obviously he talks about with his time on the Senate Foreign Relations Committee. But, you know, it's not lost on me that it's the start of the new year and he's sitting down with the president of Mexico and the prime minister of Canada.
How much is the anti-China sentiment still a bipartisan consensus right now, given the potential reopening and the potential business opportunities?
I think you'll see a lot of that. The one thing, Lisa, that Republicans and Democrats, whatever side of the aisle you sit on, this is something that they can agree on. Usually the debates are how they are going to combat it. Obviously, when you think of things like defense, you know, you heard from some Republicans saying that they were going to make a trip to Taiwan. How can they go there if the Republicans themselves are talking about cutting their own defense? What kind of message does that send to their partners and allies like those in Taiwan? But it is politically opportunistic, especially going into 2024, whether or not you're Republican or Democrat, to make sure you are pointing aim at China, which, by the way, is also coming up on the ground here in Mexico City. You know, President AMLO yesterday saying that he's seeing more ships with more goods from Asia ending up in Pacific ports, and that's something he wants to put an end to.
AMH, Anne-Marie, thank you. Over in Mexico City, this trade story, what is it called? Nearshoring.
Yeah.
Nearshoring. Mexico could be a massive winner from that. That's what Anne-Marie's talking about there.
And that's got to be a big tenor of the discussions. Of course, there's still so many disagreements between Mexico and the U.S. that it's not such a clear shot between what we're doing now and nearshoring. That said, how much are businesses going to lead in that? Basically saying we need something that's more secure just in case there is some sort of disruption, and multi-shore rather than just focus on Asia.
We need to get Stiglitz back, Tom. Decades of globalization, lower costs, outsourcing production, and now trying to unwind some of that, and does that come with a bigger price to pay?
It is about the new globalization, John. I'll take your point on that. I think it's really, really apt. I would go back to what Roche invented, which was labor arbitrage. And this is not only China to Mexico, which is frankly pretty ancient, but it's across the Pacific Rim as well. The labor arbitrage to Vietnam, you mentioned Korea earlier. They've owned the high ground on this with Singapore, back to the Tigers. But the labor arbitrage here post-pandemic is an unknown.
The big question for me is whether shareholders are going to allow inefficiencies baked in, or that labor arbitrage to basically be shrugged off in favor of strategically better positioned, and I put better in quotes, kinds of supply chains. Because ultimately there's going to have to be some sort of pushback from shareholders if they really do prioritize profits in the near term over everything else.
I would suggest the history is China will aggressively respond to any labor arbitrage.
Well, you try to incentivize it, don't you, with credits? And that's ultimately what's happening in the United States with EVs. And you can already see how controversial that is, never mind China, between Europe and the United States.
Is the EV thing working? To me, I'm not informed on this. A Rivian drove by me the other day.
When you say working, what do you mean by that?
Is the experiment of EV working?
Is there
right
real
now?
Demand for it?
Growth. I mean, the cars are really expensive.
There's massive demand. I think you just have to ask Ford.
You can't get a car, right?
Huge demand. Question I would ask, and there's a risk factor for that industry, and I think a lot of the analysts are on the same page, and it is a risk factor, perhaps the tail risk, is that you invest a ton of money into this for projects that are going to go on for decades, and then all of a sudden a better fuel comes along.
Well, yes, that's a question. Or the potential for scarcity of lithium and some of the ingredients that go into the batteries to make these. Just want to say this, EV sales nearly doubled from 2021 to 2022. They account for about 5% of U.S. car purchases.
I'm going to run. Matt Hornback and Morgan Stanley.
Like, peace out.
In the next hour. I don't mean run instead of drive.
Did I say something wrong?
No, just I've got places to be, Tom. Morgan Stanley's Matt Hornback on a weaker dollar. Cameron Dawson of New Edge Wealth on why the bull steepener is the thing to be afraid of. We'll talk about that, and we'll catch up with Matt Miskin of John Hancock in the next hour.
Piercing. Bloomberg Surveillance, we say good morning to you. An interesting Tuesday morning. Don't forget crypto this afternoon, New York time on Bloomberg. A really, really tumultuous moment for crypto. Really, I don't even want to go into it because I'm frankly not qualified to go into it. But look to crypto this afternoon for Binance and all that's going on there, including the Coinbase announcement of an hour ago. The number's not a big deal, 950 bodies out at Coinbase, but on a percent basis, Lisa, I'm sorry, that's a large number.
Yeah, what is it, 4,000 staffers or something like that?
It's like
this is a significant
20%
portion.
or whatever.
But what you're dealing with right now is a sort of reckoning in the crypto space, and I do wonder how far that goes, the tentacles of that in terms of tech and tech investments and some of the investment firms that invested in some of these crypto platforms.
Arthur Levitt, I thought, was brilliant yesterday on Bloomberg Surveillance and Radio, the former chairman of the SEC, Bloomberg LP board member, and Chairman Levitt was heated of the limitations U.S. authorities have because of all the shenanigans of foreign domicile and that.
Which raises a question of the trust that people have in foreign domiciled funds and brokerages.
And then the data here, futures negative 21, Dow futures negative 175, VIX giving me no love, 22.45. I'm on the watch for a positive Bloomberg Financial Conditions Index. Right now, we're not going to go into that, but all you need to know, we have seen stunning movement on what is an optimistic set of discussions over disinflation. We forward that discussion now with Kathleen Bostjancic, Senior Vice President, Chief Economist at Nationwide. Thrilled she could join us this morning. Kathy, I want to go to Chairman Powell 30 minutes from now, the Reichsbank. Maybe we get news, we don't. I want you to substitute for Chairman Powell. What is he supposed to say about the gross accommodative trends seen in the different financial conditions indexes?
Good morning, Tom and Lisa. Happy to be with you. I think he's got to be cautious at this point. We're just 2 days away from getting the December CPI report. So I don't think he wants to weigh in too heavily before that number. And as you said earlier, this is not really the right forum for him to make any new pronouncements. But, certainly the dialogue has changed, right, in markets and among analysts that the soft landing scenario has received maybe increased probability now. But I think I'm still in the cautious camp, maybe the Lisa camp, whatever you want to call it. But, as inflation comes down, companies are losing pricing power, right? And that's the way it works.
Well, I've got four questions, but if she's in the Lisa camp, we might as well go to Lisa to talk to Kathy, because Kathy and Lisa are both in the Lisa camp.
Well, but Kathy, how would you push back on some of the optimism that people have about disinflation, about a soft landing, about the fact that you are seeing wages that are starting to come in, even with the unemployment rate going down? How do you push back against that and say, not really, the Fed needs to do more and growth is going to slow and go negative?
Yeah, it's possible. You never rule out the miraculous disinflation and the soft landing. You just can't do that. There's so many uncertainties, and we have to be humble, especially after the past year or so forecasting them. But that said, even if inflation does manage to come down and maybe wage growth starts to ease, even though, as you said, a really tight labor market, the flip side of it still concerns me in that it means companies are losing some of that extraordinary pricing power they've had, which was elusive, right, over the last decade. So that's got to feed through to revenue, profit margins, and eventually to equity prices. Again, you can't rule out that maybe it will be just, somewhat of a softer landing. But, I'm skeptical at this point. We saw the ISM service data on Friday. It was completely overshadowed by the fact that wage growth slowed and more than expected, and also that prices paid, part of the ISM, declined a bit. But, ISM services, now we have ISM manufacturing, along with real estate, being in recession territory, probably not long before non-residential investment, kind of joins that camp. So it seems to me the recessionary scenario is still there. I guess the question is really, is it mild, moderate, or something else?
Kathy, you mentioned a lot in there, and there's this divergence right now between perhaps profit margins coming in, the likes we saw at Lululemon, we've seen this at other companies as well, versus an economic downturn that includes a downdraft in the labor market. Could we get a pretty rocky year for equities, kind of like Mike Wilson at Morgan Stanley thinks, because of contracting profit margins, but a resilient economy where the labor market stays intact?
Again, it's possible, but I think it's threading that needle, a little too closely, or it's very difficult to do that. Unless companies really have adopted a different mantra this time, saying, well, it was so hard to hire workers to begin with, we're going to hold on to them, even if profit growth slows and eventually turns negative. I just feel the pressure will be to let go of some of the workers. We saw that in the tech sector. Now, luckily, those workers are skilled enough. They quickly found jobs. I don't think that's true, across the board.
Kathy, you're one of the nation's best at all of these confidence measurements. I'm going to call them soft economics. I don't mean that in a derogatory way. What's our confidence right now in what confidence statistics tell us?
Well, going back to my time at the conference board, and the Consumer Confidence Index is very useful, as is the University of Michigan Sentiment Index.
So what's it say about gloom and doom? What's it say about the Lisa camp?
Oh, my goodness.
Well, I think what it has told us is that consumers are saying, we're feeling the pinch. We don't feel great about the macroeconomic environment, but they had enough reserves, right? The pandemic-related savings, and the labor market was still really strong. So they kept spending. But keep in mind, fourth quarter growth, all of the spending really has been concentrated in October. November paused, right? We had a stall out in consumer spending. So the momentum going into this year is slower. And the savings are being drawn down. And if the labor market turns, even just on the margin, that's going to curtail consumer spending. The question is really the degree of all of these things, right, in terms of whether we get the softer or the harder landing.
Just to be very clear, Tom, I am gloomy about certain things in terms of trying to look at the negatives, and that's just my nature. However, I will say there is this question right now about what if you get a pretty bad situation for companies, but a good situation for the economy, and that seems to be something that's increasingly relevant.
Let me clarify here, folks. The only thing Lisa's not gloomy about are the New York Mets. Other than that, it's straight gloom.
Literally, that is a team for people who like to be gloomy. So yes, that is correct. It's sort of for group
God
therapy.
For Mr. Cohen.
But I do want to make a point though, and Kathy was talking about this. The cost of goods sold online, there was a report that came out from Adobe today showing that it actually declined because companies are losing pricing power. There's steep holiday discounts, and you're starting to see that. Kathy, this is actually a good thing, right? I mean, at what point can the Fed look to this as a disinflation, as a lack of pricing power that will lead to that 2% level by the end of 2023 potentially, or even close to it, the way that credit sites was potentially gaming out?
Absolutely. I mean, the Fed Reserve wants to see price pressures ease. Absolutely. It's just my point is in getting that, as that unfolds, it is going to be hard, I think, for companies to adjust because they are going to lose some of that pricing power, and they are working off some of these high inventories. And if they feel they need to cut costs further, that means there could be some layoffs coming, and that's going to hurt consumer spending. So that's the difficult challenge here, right? How do you get inflation down without really hurting the inflation and the economy? And maybe things are already in play, right? Again, seeing ISM services and manufacturing service index both below 50.
Right.
You don't see that unless you're in recession.
Kathleen, thank you so much. Kathy Bonchonchik there on Confidence and Confidence. She's part of the Lisa camp at Nationwide. Joining us now, he is not in the Lisa camp, is Michael McKee. I saw the Broncos for 3 minutes this week, and your beloved Denver Broncos. Good luck with that.
It's the Georgia Bulldogs that matter.
The Georgia Bulldogs won large.
Can I just did you either of you watch the game?
No.
See, Stetson Bennett, you've heard of, the quarterback, unwanted, unloved, now 2 national championships, and led the destruction of TCU last night. He's an economics major.
Well,
very
look
good.
at him.
There we go.
So let's hear it for the economists.
Are we going to see the destruction of accommodation from Chairman Powell in 20 minutes?
I would doubt it. This seminar put on by the Riksbank is about central bank independence, and it's also a panel discussion. So it's not the kind of venue where you would talk a lot about it.
But if you were there asking a question.
Well, yes, that I was just about to say. There is audience Q&A. If it's just economists and central bankers, they like to nerd out on things like central bank independence, and they don't really ask questions about whether the Fed is going to raise rates or not. But somebody in the audience might.
And what could they ask and what could Jay Powell say that would disrupt this market after so much hawkish Fed speak that this market has ignored?
Well, disrupting the market might be hard because the only thing you could maybe do in that situation is ask whether you're going to go 25 or 50, and he might give you an answer on that. But everybody knows the Fed's argument is we're going to keep rates unchanged for a long time. Those were the words of Raphael Bostic yesterday. Just 3 words for you: for a long time.
So, but Raphael Bostic, and that's where I wanted to go, he was talking about how raising 25 basis points the next meeting looks likely, but not potentially dovish, right? Basically, their end point stays the same. Is that the new messaging here, that don't rally if we raise only 25 basis points? That doesn't mean that we're about to pause?
Yeah, I think that's definitely a message that they want to deliver. And I'm sure that if they do 25, Jay Powell will come out and make that clear in his news conference. Interesting research from Goldman Sachs this morning that suggests, at least as far as they're concerned, that the impact of the Fed's cumulative tightening is hitting the economy right now, that long and variable lags are shorter than people think, which means the economy will be growing faster than people think in 2023, and they'll have to raise rates more than their forecast.
Tell me the next book. Olivier Blanchard wrote my essay of the year next year. He's out with a new book, folks. This is thin, gorgeous Blanchard here versus his intermediate macro textbook, which I've read cover to cover twice. This is a really important document, and he talks here about the algebra underlying all of your world. Does Chairman Powell believe in the algebra? Does he have a model right now he can trust?
He doesn't have a model he can trust. However, they do use the models because it's what they have, and it gives them some guidance. But at this point, the Fed concedes, as everyone else does, this is a different kind of recovery. I mean, maybe Stetson Bennett knows the models, but...
You think you better watch some more games just to make sure.
It's just been like the greatest day. The conversations today have been extraordinary.
They have been, well, like they always are.
We finished strong. Olivier Blanchard will join us in the Peterson Institute. That will be absolutely must-watch for Global Wall Street. Futures negative 20. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, JP Morgan CEO Jamie Dimon says that the Fed's rate hikes might need to go beyond what's currently expected. Still, he told Fox News he's in favor of a pause to see the full impact of last year's increases. Dimon said there's a 50% chance the Fed will raise its benchmark rate to 5% and a 50% chance it will go to 6%. The UK's attempt to send the first satellites into orbit from its own soil has failed. A rocket launch from a Virgin Orbit Boeing 747 that took off from England malfunctioned. Now, that led to the loss of its payload of 9 satellites. The jumbo jet and its crew did return safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order from the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. And Bloomberg's learned that the drugstore chain CVS is exploring an acquisition of Oak Street Health, which runs primary care centers for Medicare recipients. A deal could value Oak Street at more than $10 billion, including debt. Shares of Oak Street are soaring today. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Months ago, there was barely any pull to be found on Europe, right? So that's not long ago. That's just starting now, right? That shift is just starting. So I would really expect there is a bit more, a bit more positive, a bit more of a positive run to go for Europe, both on the credit side, on FX, and on equities.
Max Kettner of HSBC with the optimism of HSBC and others, I should say, on Europe. We see it with dollar weaker trend in place. DXY with a 102 print earlier this morning shows the tumult, the change that we see in 2023. Last year, in the shock of Ukraine and Putin and Russia, I named my book of the year in February or maybe the first week of March. It was the absolute must-read, Putin's World by Angela Sten. I'd never had a book of the year that early. And I'm not going to top it this year with Olivier Blanchard's magisterial fiscal policy under low interest rates. All you need to know is this is the definitive short read with the rigor of the Massachusetts Institute of Technology and Blanchard. It is the immediate must read for every economic geek that is out there trying to get smarter, trying to get curious. Blanchard of MIT and the Peterson Institute, the former chief economist for the International Monetary Fund, joins us this morning. Olivier, Lisa's going to vault into your wonderful new book, a short but dense read. I need to go to my essay of the year for last year, which is you late in the year in the Financial Times, where you said, everybody calm down. The American public doesn't worry about inflation at 2%, and the new 2% worry is maybe a 3%. What happens to our financial and economic system if we get the level of 3% with inflation? Is that the new 2%?
Well, that's not my decision to take. It's a decision of the central banks. Part of the book is based on the fact that when we had the target of 2%, which we still have, this implies fairly low nominal rates on average, and that really limits the ability of the Fed to help the economy if it slows down. You can only decrease the rates by, if the nominal rates are 2% or 3%, by 3%. And what we have seen over the last 20 years is that that is not enough for the Fed to actually do the job, or the ECB or whoever, any central bank. And so I have argued that it might be better to actually run the economy on average at 3%, which would imply higher rates, which would give more room for monetary policy, and would make some of the issues in my book less relevant, because if monetary policy can do most of the job, it should do most of the job. If it cannot, then fiscal policy has to come in, which is the title of
Olivia, and this, Lisa, is so profound. Professor Blanchard at IMF with Stiglitz talked about 4%, and that was hugely controversial in 08 and 09. And this is a bit of a different discussion, as you and I have heard from his colleague at Peterson, Adam Posen.
Right, this question of do you let it run hot? But on the flip side, and Olivia Blanchard, the title of your book, Fiscal Policy Under Low Interest Rates, Fiscal Policy of Trying to Fuel Growth when Monetary Policy didn't have room to do so, does it get flipped on its head, especially after fiscal policy created the problem that monetary policy is now trying to address?
So, as you may know, fiscal policy can do too much. And I think that we're paying, in large part, the major fiscal policy mistake. There was no need for the very large programs that we saw in 2020, but more especially at the beginning of 2021, which led to very large overheating of the U.S. economy and supply chain disruptions, which would have been there, but were probably aggravated by it. And in general, overheating in the world. So yes, I mean, there's such a thing as using fiscal policy too much. I had the sense that although I was arguing for using fiscal policy, the Biden administration in particular was probably doing two times or three times what I would have liked. And the result has been, indeed, there are some other reasons, and clearly Ukraine has been very high inflation, and the Fed has had to react the other way with very high interest rates, or relatively high interest rates. I think that's a phase. I think that the book is really written looking beyond the current inflation episode, the current higher rate episode. And one of the theses of the book is that we're probably going to return to an environment in which the rate that the central banks need to choose in order to get the economy at potential is going to be very low again. So we're again going to be in this situation in which There might be constraints on the monetary policy, and fiscal policy has to do more. But the point is, clearly at this stage, the discussion is very much about the high rates. So there's a bit of a provocation in coming out with a book where the title of it is Low Rates. But I would argue that first, they're not terribly high. They're surprisingly low at the height of the battle against inflation. And there is no reason to think that they will not go back to something like we had before COVID.
So then where does that leave the Federal Reserve, the ECB, in terms of the balance of risks? Is it to go too far with benchmark rates and hold them there for too long now? Or is it to not do enough, given that we are going back to perhaps something that is slightly different than what we experienced over the past several decades?
So I think that with respect to the inflation process, I'm slightly older than you are. And so I've seen it before. And it seems to me, and maybe Tom is in between us, is my guess. It seems to me that I have seen it before, and the issues are always the same, which is, well, inflation is too high. Part of it is going to go away because part of it is due to energy prices, food prices, and these are going to decline. They have started declining. But, we still have to basically slow down the economy a bit, and we don't know how resilient the economy is, right? In the textbook, or in the simplified stories you hear on the radio, you basically increase the interest rate and the economy just slows down. But you don't know how easily you get to that.
Right.
So I think that's what the Fed, the ECB, and all central banks are facing, which is, should we do more, should we do less? And then there are two issues, if you give me 2 minutes more. The first one is that there are what we call lags, right? Which is that even if it works, it doesn't work right away. And so you have to kind of stop tightening or going easy before you actually have seen the results, because the results take 6 months or a year, right? And then the other aspect, which I think is relevant in this case, is that some of the factors which increased inflation turn around on their own, independent of the Fed, independent of the ECB.
Right.
So energy prices go down. And there's what I've called a false dawn, which is inflation falls, and it is falling now, month to month. The numbers are very, very good. And some people say, okay, we're done. Please stop.
Olivia,
that is not right.
I got 1 minute left. Olivia, I'm going to rip up the script here. I got Alan Blinder writing in the Wall Street Journal that disinflation is intact. Krugman's been pounding the table on this for months. You know the history of 47, 49 into the Eisenhower deflation that we saw in 52.
I'm not that old, Tom.
You just, thank you. But Robert Solow is who you dedicated your book to at 98 years old. Do we have any clue what...
in great shape.
Do we have any clue what we're doing, Olivier, given disinflation in place amid technology? Solow, the laureate Paul Romer, the should-be laureate Olivier Blanchard. Do we have a clue where we are, given the technological progress that Solow invented?
Yeah, I think we do, but there's uncertainty. I think there's the usual amount of uncertainty, which is, the economy is always changing, so you have to take this into account. The response to interest rates changes as technology changes and so on. I think for the moment, we're roughly where we should be. It looks like we have it probably more or less under control. The really difficult issue, Tom, is what is the unemployment rate that we can sustain? Can we basically get inflation down all the way to 3.5 as it is now and keep it there? Or do we have to accept slightly higher unemployment in order to stabilize inflation? And I think that's the big issue. That's where all kinds of technological issues come up, matching, reallocation, all kinds of things like that.
We are out of time. Olivier Blanchard at the Peterson Institute, without question, my essay of 2022 in the FT. And here in celebration, Lisa, I'll read it for you cover to cover so you don't have to read it. Fiscal policy under low interest rates, it is blindingly terse, but very dense. There's a lot of algebra in here.
I love that you handed it to me mid-interview to read quickly before talking with him. Okay, all right. Thank you. You did a great job. I understood it all. It was great. No, honestly, his point there, though, is very well taken when we were talking about the balance of risks. It's wrong to just take some of the disinflation that we have seen and say, game over, inflation's dead.
Can you handle this chart? I think Lisa, this is a chart for the Lisa camp here. This is R minus G. Major shout out to Larry Summers and Bloomberg Economics' David Wilcox for pushing Blanchard to write this beautiful, beautiful economic treatise. Stay with us here. Futures in -16
This is Bloomberg.